Professor, you're on mute.
I'm so sorry. Thank you, Dirk. Thank you, Som. So, any other questions from the audience before we move on to the panel discussion? Good. So we have a discussion coming up on how the new products by derivative exchanges are shaping the gold trade. This was supposed to be moderated by Joshi Jacob. He's still not here. So this is so we have Mr. Shivanshu Mehta, head of bullion products at MCX India, and Mr. Nagendra Kumar, NSE India. So over to both of you. Mr. Nagendra and Mr. Shivanshu.
Yes, thanks, Professor. Hi, Nagendra. How are you?
All well, Shivanshu. God's grace. Surviving. So, Professor, do we wait for Mr. Joshi to come, or how do you want to structure this? Or
I think we can start off. Maybe we can start off by with maybe an outline of some of the key issues that we're going to discuss, and then maybe we can open it up to the audience for questions. So, would you like to go first, Nagendra?
Can we give the commodities the market leader
yeah, please,
take the opening slot?
Yeah, please go ahead. Joshi, so Joshi will be joining shortly, so but we can start. Yeah.
No, sure. I mean, either way, thanks, Nagendra. I think the context is pretty much set by IGPC in this conference. It essentially contours whatever are the latest developments, what are the asks before us, and what is the broad direction in which we as an industry need to flow. So in keeping with that, I think before me today, I had, I was privileged to see the sessions of Jyoti Srinivas, David Tate, as well as others, and some very interesting observations in the professor, both the professors who shared their research papers, and interesting points raised by
There is some audio issue.
Shivanshu, we lost you in between.
So I think, okay. Oh, sorry. I think the network is iffy. So like I said, there have been some important policy moves which we have witnessed over the
Shivanshu, we are losing you, Shivanshu.
Shivanshu, may I suggest you switch off your video and just be on audio, then we can hear you. Shivanshu, I'm so sorry. Can you hear me? Just switch off your video and be on audio.
So Joshi is back now.
Yes.
We just I think the discussion just started, so you're right on time.
Yeah, I'm sorry we had some audio issues, so we had to migrate to another facility very quickly. Good evening, everyone. Thank you, Sanket, for chairing the session so far. We have a very exciting session ahead on new products related to gold. And we have with us two esteemed panel members, Mr. Shivanshu Mehta, who's heading the bullion products at MCX, and Mr. Nagendra Kumar, who's CDO commodities business at NSE. Welcome, Shivanshu and Nagendra.
Thanks, Professor Jacob.
Shivanshu and Nagendra, we can.
Oh, am I audible now? Is it any better now?
Yeah, much better. Please go ahead.
Okay.
Yeah.
So I think now that the moderator is here, let him steer the session. I was just trying to contextualize the sessions before me and also put into perspective the great regulatory reforms that we are seeing on the international bullion exchange as well as on the domestic side by SEBI by way of new products coming in. And we've seen the asset class come back into favor is one thing I said during the COVID pandemic. And the products designed around it, the products which sort of have started getting more and more participation from the retail, etc., is what we'll be discussing. So that's all I wanted to say. I hand it over to you and Professor Jacob.
Yeah.
Thanks.
Sure. Let's start with this very exciting product that actually recently launched in the market. This is called Petals, and it seemed to have really clocked a very large volume. I think it's about 35 kilos clocked in a year. Yeah. So Shivanshu, what do you think is the excitement about this product?
Right. So I think it is incumbent upon us as a leading bullion exchange to come up with any product which can actually make this asset class and its accumulation more organized. That is the theme. We thought it comes along with a deliverable, a 1 gram denomination, a tamper-proof product with a certified, a certi card which it carries, and we have seen that because of its, the cornerstones of its design are basically electronic accumulation on the exchange system, DMAT system, as well as the liquid order books that we have. It sort of paves the way for a SIP type of a functionality. So this was the theme. I think as far as the results are concerned, it's doing about it's seeing a fair volume for a small product like that of about 40 crores, 35 to 40 crores a day, and we are seeing about 3,000 daily client participations, which is a good number to go by. And we feel that while it's a futures platform, we can't really replicate a spot-like functionality, but the advantages of liquidity and depth, which in a product like this matter to a retail participant, is probably being seen. It's been about a year and a few months since this product came into life. So we are happy to note that. And of course, we continue to be committed to bringing more and more such products in the future.
Okay. Nagendra, just if you could elaborate how this product probably has impacted the demand for ETFs and digital gold, if it has. Will you see a shift away from the other two, which is ETF and digital, to the gold metal, or these markets are actually unmixable? What do you see in the market?
Yes, Professor. See, I've got some interesting data which I would like to share. And if we look at the ETFs, ETFs have been in the market for, not many years than the Petal product which Shivanshu was talking about. And if we look at the numbers, if we take only this financial year from March, and February 2020, the ETF numbers were in a month. I'm talking about the total gold ETF numbers. In NSE, we were doing close to 450 crores, right? And Shivanshu, with your permission, I looked at your numbers also. In Petals, you were doing around 99 crores. This is for the entire period, right? And from March, when the lockdown started, the numbers went 3 times, right? So as we speak, in the month of January, we have done close to 1,245 crores overall for the month. And whereas in Petals, it was close to 600 plus crores. So if we look at the numbers, yes, I mean, the petals volumes are growing. I mean, they are 50% to what the ETF numbers are. But having said that, other interesting data which I would like to give is that in the last 1 year, I mean, we had 8.9 lakh investors who have traded in gold ETFs. 8.9, I mean, you can approximate it to 9 lakh investors, of which 80% of them have traded for the first time. So assuming it's 9 lakh investors, you can very well say that 7.2 lakh investors have traded for the first time, which is twice that of the previous year, right? I mean, looking at the overall number of investors, from a turnover perspective, the turnover has gone up 4 times, 3 to 4 times. And from an investor's point of view, it's 9 lakh investors for the first time, right? And of this, 70% are retail. So which means 6.3 lakh investors have traded in ETFs. 20% prop and 10% is domestic institutional investors. And again, if we look at that, I mean, the Goldbees tops, I mean, Goldbees does close to 70% of the entire ETF numbers. The reason why I just wanted to share these numbers is, I mean, when compared to the other commodity exchanges, I mean, thank God ETF is part of our equity segment. And today we have 96% market share as far as our equity volumes are concerned. And our terminals are present all over the country. I mean, we have more than 250,000 terminals in the length and breadth of the country, and algos are allowed. I mean, co-location is allowed. I mean, you have different set of participants all together. I mean, some of the big bullion guys also trade in ETFs. So I don't want to say that, we will continue with our leadership position, but with, again, due respect to what the MCX contract is doing, it is actually not a dematerialized contract. I mean, I just wanted to, for the benefit of the participants, make this differentiation here. When there is a physical delivery of the commodity, it is safe kept in the vault, and there is an electronic entry which is passed. It is called immobilization, right? It is not actually dematerialization. Dematerialization is a concept where, the physical asset doesn't exist at all, like our share certificates. So having said that, I mean, end of the day, again, we talk about retail investors wanting to take physical delivery. We had Mr. Reddy talk about how things were during the share certificate era, right? You always have that issue of, theft, losing your gold. I mean, so, I mean, with, again, ETFs being ETFs, you can store it in a dematerialized form in the depository. We feel that ETFs can always maintain a decent margin over the petals contract.
One concern that Nagendra has been raised throughout, ETFs still seem to really have, has not really merged with the international markets, leaving some arbitrage up and down. So why is it the market not really necessarily closing and very clearly trading to a benchmark like IIMA? Is it because there is lack of institutional participation, or the authorized participants are probably not really actively engaged in arbitrage?
Professor, 10% of the trading community is DIIs, domestic institutional investors. That's a very decent number to talk about. And if we talk about the way the ETFs are structured, we have a 1 gram ETF. I mean, the price, if you look at the price of an ETF to price of 1 gram, I mean, there is definitely a difference. I mean, it doesn't reflect actual price of a petals contract or a spot contract, because the way the ETF issuer, right, the way they structure, for example, if you look at Nippon, they have 1/100th of a gram. The price is around 41, right? The 52-week high was around 51 plus, and today they were at 52-week low or 40 point whatever, right? So for we to say and make that assessment saying it doesn't reflect an international price, I don't want to make that statement. I mean, because if we look at players who are actually trading on ETFs, I mean, it is some of the big guys who have the physical gold. They place it with all these ETF issuers and convert them into ETF units. So ETFs will definitely have a premium element factored in, for the simple reason that it is in a dematerialized mode, where you're going to store your inventory. And but by and large, I mean, I don't have the data to support my statement, but I'm 100% sure that the prices will be correlated with international price movements, Professor.
I have a small question.
Sorry.
Yeah,
Sorry.
please go ahead. Yeah.
I wanted to just come in. See, actually, all these instruments are they have different characteristics as such, and they have their pros and their cons. So, if you really want to compare ETFs, then you would have to compare the sum of all the products in the futures. It's not only gold petal is a different thing to talk about. If you look at the liquidity which the futures platform has, the bid ask, the depth of the order books, and the most beautiful aspect of it for the physical industry, that the being a deliverable compulsory delivery futures, it has the play of parities and disparities which prevail, and then they are met by compulsory delivery. So that kind of vibrancy, all the weapons in the thing, in the all the arrows in the quiver, only a futures platform brings. While ETF it has its own outlook, it has its own type of a clientele, but it has again liquidity type of issues. It can definitely index around commodity derivatives. That's why now the regulator has permitted ETFs based on commodity derivatives as well. And we are seeing that the leverage that provides to the funds because of the participation in underlying as well as the fund on the same platform. So all those things really come in. And if you really look at the overall volumes of the futures, then you can compare with ETFs. So overall volumes of futures, we are doing about 18,500 crores a day in the bullion futures today. So then you should make a comparison there. That's what I feel.
Shivanshu, you are an undisputed leader as far as the bullion futures is concerned. I mean, so no second thoughts. Nobody is going to oppose that. You give us some more time.
I'm just trying to compare the.
Yeah, perfect, Shivanshu. No?
Yeah. Can we come back?
Please.
I just wanted to ask. Do you think
Actually, we can't hear you clearly. There's some audio issue.
I think the IT support has to mute themselves first.
Right. Yes.
So in the meantime, let me just ask a question. Nagendra, do you see? I mean, saw this huge increase in ETF trading and new retail participation. So do you think that's just a COVID effect, or is it something related to other factors involved also?
Okay, that's a lovely question. I mean, so for the benefit again of the participants, I mean, I just wanted to say that NSE, for the second consecutive year, we have been rated as the world's largest derivatives exchange. So calendar year 19 was the first year, and calendar year 20 was the second consecutive year. We have done close to 8.5 billion contracts. I mean, that's on the derivative side. So your question is mostly on the ETF side, and just the way I gave you the ETF numbers on the equity segment of NSE after COVID. I mean, from the day the lockdown started till date, we have close to 70 lakh new PANs that have got registered on the equity segment. 70 lakh PANs. I mean, most of them would have got traded. We don't have those numbers. And I mean, we have spoken to multiple analysts, some of the research heads at various large broking houses, and the reason that we have got is that the COVID has impacted basically people who are on the lower end of your segment. I mean, people who are on middle class, upper middle class, high class. I mean, they were enjoying the benefits that they were getting. I mean, work from home. There were a lot of restrictions in terms of where they wanted to spend their money, no going out to malls. They were not able to, I mean, no foreign travels. So the disposable income was increasing, right? So, and with a lot of news saying, I mean, the COVID is going to extend, gold is the only safe asset. And there was a rally in gold also, right? I mean, the March, it was around 4,000 and it went up to 5,600. So I mean, it is obvious. I mean, if you look at all these data points, you can very well say with some degree of confidence that, COVID has actually played a significant role for people to invest in not just gold, but also in a lot of other asset classes. Thank you, Professor.
Thanks, Nagendra.
Yoshi?
For sharing the numbers. Am I audible?
Yes, Professor. Yes.
Thanks, Nagendra, for bringing clarity on that issue. So this is a question which is everyone would be concerned about. That with increasing crowding in the market, various products, petals, futures, options, and then you have ETF which is surging. What is the future of digital gold? Shivanshu, can you take this up?
Yes, I think adding to what Nagendra said, see, digital gold also comes into flavor. We have seen since March when gold rallied from 39,000 odd to 56,000 and silver more than doubled. So there was an absolute rush for this asset class. And there was also a period of lockdown where physical availability was a question mark. And you saw how the EFP, the spread widened between the LBMA and the COMEX to never ever seen level. And the beauty of the fundamentals of gold and silver, and they wanted to be part of this rally somehow or the other. Just like you saw on the equity side, there was a rush to open demat accounts. Obviously, the unorganized portion of the trade just fell off because nobody could trust anyone. A lot of this also helped garner more interest onto organized books and digital gold. Digital is also one such platform where you are assured, you have convenience, and we have certain large, digital players who are into like, Safe Gold, for example. They are actually hedging themselves onto MCX. So we have seen such hedgers of digital from the digital fraternity actually increase their share. And having said all of this, then it doesn't remain any coincidence then that the volumes of silver today, what we see, as well as gold on the future side, have gone up by even today year-to-year basis by around 75%. So digital gold is nothing different. It's not going to be a different storybook as compared to this. It is pretty much the same convenience, quality assurance, and the backup of actual delivery if you want it. These are the same fundamentals which apply there.
And Professor, if I may add just one point, I mean, for me, digital gold, I would not take into consideration the Paytms or the safe golds. I mean, if you say the sovereign gold bond is also a digital in nature, right? I mean, it's again a digital gold, but there may not be a convenience, but from an investment point of view, if somebody is looking, it is again safe. It's going to give you an assured return, and the prices at the maturity are linked to the market. So if you look at from a long-term perspective, I think that's one area where again we are working with IGPC team to see if some consolidation can be done in that space, because now you have multiple tranches. So when you have multiple tranches, the liquidity obviously is getting fragmented. So it's all a matter of time, and once the consolidation happens, I mean, that's one space where I think we should keep looking for some traction.
Yeah. So that brings a lot more clarity on how space is working out. So on the petals product itself, how do you think, Shivanshu, will we be able to really attract a lot more of participants from the ETF market and digital gold market in the petals? Do you think that's possible? If so, why would and how would that happen?
So, yes, I think, see, one thing is for sure that on a futures platform, while we say we replicate the spot, but that's only during the delivery and tender period towards the end. So as far as a spot-like functionality is concerned, yes, we have it, but we don't have a spot market as such. So which is why things like spot exchanges are being thought of now at this stage, after the futures and options platforms are already available. To that extent, is different. But then, having said that, the digital advantages of a digital product are all existing in exchange traded futures, because they carry the same advantages of holding it if you want in electronic form, taking it out in physical form whenever you want. At the same time, you get more advantages which are by way of a futures liquidity, a futures systematic buying at various price points, and the depth and liquidity, which actually, because it's actually a sort of an amalgamation of various types of physical participants and financial intermediaries and retail clients and jobbers and arbitrages. So it is a place where all of that meets, and you see that resulting in when we record of 140 metric tons, when the disparities were in terms of spot to futures integration. So it is slightly over and above that. But yes, retail attraction will grow not only for petal, but for all such products. So today, if we have more than 30 lakh, registered clients who may be active, this number can go much, much higher over a period of time. And to each his own, really. Each product carries its own advantages. It's not like one over the other, according to me.
So one of the issues which usually one can visualize is every gram has a roughly 2% or so transaction or making charges, right? And if, is there a facility for one to really accumulate, as many grams that we like, and only incur this cost once? Because this seems to be like, something that is a disadvantage compared to, other forms. Is that true?
I'm not sure. Professor Jacob, I could not hear it clearly, please. Is it at my end or?
I can repeat the concern that I was raising, that you have making charges on each gram.
Yes.
There's some way the participants can accumulate, multiple grams over the transactions and then economize on that, because the making cost is not really, per unit, but it could be upon a certain quantity.
Absolutely. Yeah, I heard that this time. So I think the idea behind keeping a nominal making charge and keeping it over and above the traded price was basically transparency. And this transparency does help, because one is that you're assured of a product which is going to be along with a certificate, and it's going to be tamper proof like a credit card. And at the same time, you actually are able to accumulate it, and the making charge is clear, well known upfront. It's 100 rupees. So definitely, if a person wants to accumulate it and then see, this is the model which these companies of digital gold are actually doing for their clients. These people, they accumulate, end of it, they can actually pay the making charges, and the GST on the making charges is much lesser, as you're aware, and to the jewelers. So these type of things are actually taking place. These are small revolutions which will happen unnoticed. But I'm aware of a few companies who are doing this backed by our contracts for their clients.
So your view is that the tokenization is actually going to continue and expand and bring more clientele to the market? Because being able to trade 1 gram sounds quite incredible, right?
So I heard that as our views on how to expand the retail market. Is that right, sir? Okay.
Yeah. So is your view that this gold market is going to increasingly getting tokenized? And, if you have 1 gram now, everyone wants to really launch a similar contract. Is that kind of way ahead? Or this just got happen to be just a niche product and that's it? Is that the way you see it?
No, so I think in that sense, it is the only such contract which exists in the world. So while nobody plays for records, but it is a record to that extent. But I don't see these are low volume driver products, and we are not in it for volumes as such. I mean, if silver is doing 10,000 crores, gold is doing 9,000 crores a day, this is doing just about 40. But it's the commitment to the retail industry which matters. It's like creating an organized way to accumulate this asset class. So we would like to maybe watch it expand and grow over years. We remain committed to it, and every other seminar that we do, this is part of it. This really, we want this to spread, and maybe in a country like India, which has a excellent rural population, and you find that household domestic helps also accumulate every month, and what they accumulate is gold. So maybe such a product can actually help create a revolution over a period. We also have a presence across India, across cities and centers which are more than 1,100 in number, and postal codes which are about 8,000 if you go by pin codes. So there is a spread available, and then the number of terminals run into lakhs, and the clients are above 32 lakhs, which can go much more. So maybe this can actually create something beautiful over the years.
So the other interesting revolution is happening in the options market, and their NSE seems to have made huge gains. What could be, can you just explain how options got a lot of fancy of traders in the market within a short time?
Well, thanks, Professor. I mean, in the last 2 years in our conferences, we discussed a lot about this options contract, right? And even during that time, we were making a statement saying that, if we launch options on gold, I mean, definitely there will be a differentiating factor. And obviously, we have introduced one with a differentiating factor, 100 grams physically settled. And at one stage, all the 3 exchanges were running the product. And I'm sure that, everybody here would agree that we have done decent numbers. I mean, I'm not saying that, we have achieved what we wanted to achieve. Still, I mean, it's a long way to go. And why have we done well in options? I mean, today Nifty is world's #1 contract. I mean, that there is absolutely no denial. From 2013 or 14, we overtook KOSPI, the Korean index. And as far as options market is concerned, I mean, in India, NSE is the thought leader. I mean, we have done extensive work in options, and the way we have started our engagement model is completely different from what the other exchanges have been following. I mean, we have India's top jewelers, who have started trading with us. I mean, we are so happy and excited. In futures, we are still scratching, but as far as options are concerned, I mean, we are able to give them a value to what they are looking at. I mean, we are able to structure. We know it is a leveraged product, but at the same time, we are able to structure to the needs of the customer. So we have some of the big bullion guys, big jewelers. We are looking at institutions. I mean, I don't want to disclose who's trading what, but having said that, I mean, it's definitely a rosy picture, Professor. Thank you.
That's interesting to know. So something that seemed to have not really taken off, while there is a lot of frenzy for products and many products are succeeding, is actually the good delivery standards based in India. I think both the exchanges have made some effort to really, make it a benchmark, but that seemed to have not really gone that way. Can both of you share your experience with the delivery standards effort? Maybe you can start with Nagendra and then go to Shivansh.
So we were into this exercise for quite some time. I mean, we put an extensive research, a lot of effort. I mean, the culmination of our 2 years effort resulted in the standards. We went live in September, and see, our standards are pretty, I mean, I don't want to use the word stringent because, it is not a race to the bottom. I mean, since we are trying to compete with an existing international benchmark. I mean, we thought as a market infrastructure provider, we also play a role of a mini regulator, right? So we have to ensure that we give that confidence to the end customers when they trade on our platform. If any bar which is getting delivered or routed through our delivery system, I mean, the end customer should close his eyes and blindly have that faith saying, these guys have done all the groundwork, they have a robust framework, and the bar can be assured of its quality. And that's one. And the second thing is, for every bar which has to get delivered in the system, I mean, we have a reference sample testing process. I mean, some of the refiners, without naming, I mean, they find it a little bit cumbersome. And in terms of why we have not attracted eyeballs, again, I mean, we all know that liquidity begets liquidity. I mean, only if you have liquidity, I mean, people will talk about, what are the good things and the great things that you're doing. I mean, having said that, I mean, congrats to Shivanshu and his team for launching good delivery standards. And at this point of time, our only request to MCX is, I mean, now that I've not looked at your standards, I mean, if we can raise the bar and keep it at a particular level without diluting, right? Again, in the interest of the market. And at some stage, I mean, if any of the associations can pitch in, maybe, Mr. Somsar or IBJA, I mean, how do we share the information? Today, if a member of NSE is also a member of MCX, and if there is an issue in NSE, obviously there is an information sharing mechanism. So how do we extend the same relationship as far as the refiners are concerned? Because I've got some stringent standards. I mean, assuming that you will also have similar airtight mechanism to ensure that, it's only qualified refiners who come into the system with quality bars, right? How do we, I mean, if we can look at building a bridge sort of a mechanism to share information, again, in the interest of the market. I mean, end of the day, as you said, we are not here for business or whatever. I mean, that is secondary, but primary is that how do we build that credibility and give that confidence to the market saying, right, our standards are at par with global standards. And I mean, we are no lesser than, what people think our standards are. So over to you, Shivanshu, if you want to add.
Yeah. Thanks, Nagendra. So I think, Professor Jacob, yes, I think as far as the strictness of the standards at MCX is concerned, you can well make out that we started this exercise in January 2020. And we have never felt the need to hasten up our pace. We have tried to go into areas which make things difficult for us. We've had committees who make things very difficult for me to, whenever I want to, say that, okay, this thing looks clear. No. So right, starting from the screening audits, we did technical qualification audits for refiners of the process, of the compliance with the India Good Delivery Standard, with the IS 17278, of the assaying abilities as per the IS 1418, and over and above that, certain other equipment, machinery related details. And we've even gone to the extent of ensuring that it's a continuous improvement for the refiner. It's not a one-time thing. And we are, as per our good delivery norms published to the market as recently as January 28th, we've made it pretty clear that this is an ongoing continuous compliance oriented activity with screening audits, surprise audits, checks at any given time from any vaulted stock, and the powers to disgorge in terms of penalties of a very hefty nature. I think we have that in common, and that is something which then leads to a trickle down type of a result at the bottom, while there may be many refiners who are still in process, but there are only 2 who have finally cleared everything as on date. There are many more who are in the pipeline. So this as on date, I mean, yesterday we've announced the refiners who have been impaneled. Now, having said that, see, there's a history of delivery at our platform. We've done close to 119 metric tons of gold and about 3,500 metric tons of silver. So deliveries take place every month here, and we need to be very, very sure before we take such a step, which we have done. Now, as regards success, I think we have not even bowled the first over yet, but we already have those people active on our platform delivering imported bars for maybe a decade. So it's only a shift to the expansion of the good delivery list as far as we are concerned. We want to integrate deeply with the physical markets, even deeper than where we are today, and this step will take us there. The disparities which prevailed in September were only an example where silver was at 4,000, 5,000 rupees discount. And at the end of the day, we had a defaultless record delivery. What does that mean? It means that people picked up that silver, made it exchange good, and they delivered. So what is India good delivery, which is different from that? It's basically the same thing. So it's not that tomorrow the results are already there. We just want to expand more and more deeper into this industry, and you bring benefit to it by taking away these types of disparities across the country, which prevail at times. You've seen, and not only disparities but also a price. The Indian refiners who are of quality, why should they not get the same premium? If our contract is reflecting a certain premium over the international parity, now the Indian refiners, Atmanirbhar Bharat, they would be able to enjoy that premium because they are also producing quality which is at par. So quality-wise, the BIS standards are, there is nothing different with the international standards. They're equally strict. And beyond that, the audits which are conducted are very, very stringent. As far as the results, I think definitely we should speak maybe in the month of April when we go into delivery for the first time with the Indian good guys. And I'm pretty hopeful that we should be seeing some good numbers there. I'll definitely keep you posted on that.
Thank you. That's like a really great stage for gold business in India. We have one last issue, which is about which are the products you think are like to be launched to cater to the market. We take inputs from apart from options, futures, digital gold, petal, and ETF which we have. Is there space for anything else? If so, what kind of product that could
be? Yes, sure. Nagendra, would you like to talk? Or should I?
Yeah, Professor, on the 1 gram product, we are trying to enhance on what the petal product is all about. I mean, we are working with the regulators. So as and when we get the necessary approvals, I mean, Shivanshu said it's a revolution. So we definitely want to be part of that revolution. But again, I mean, we are taking all the necessary inputs from how they have structured their contract. That's the base. I mean, we are trying to build on that. And once we have the necessary approvals in place, I'm sure that the product will find its own place in the bullion market. So we are just awaiting regulatory approvals.
Yep. On our front, basically, we should talk about the index when we say innovation and upcoming products. It's a very recently launched product, as you would be aware, the Bulldex, which is a combination of our benchmark silver and gold futures. And it has, shown some very, very encouraging results. And it's basically, a contract which is cash settled. It is a contract which is of an intermediary tenor, unlike the 2 parent futures which are of bi-monthly nature. It carries with it a portfolio-based approach to commodity derivatives. It's like owning, it's like what an index product typically does. So it is an investment-oriented approach. And we have seen that it has already hit a average daily volume of 3,500 lots. And at present, the open interest is close to 2,000 lots. And it captures both roll as well as the normal returns. And it is a real-time, index. And the weights as of now are 66% and 33% odd for the gold and silver. And we have seen from the number of member and client participants per day, it's showing a lot of keenness which we are watching. So we are pretty excited about the Bulldex and maybe some upcoming other indices also, which I can talk about at a later stage. And we may see even our existing options is a new product, 3 years old. It is again, whenever there is volatility, showing 3,000 crore odd volume, a kilobar option on futures, which is showing traction even more now than it did a few years back. So these are some of the exciting things we are looking forward to. And of course, let's see on the ETF front if there can be something on the silver side. Thank you.
Thank you so much, Nagendra and.
So there is a question from one of the audience.
Yeah.
There's
Yes,
a question by Pradeep Unni.
Please.
Pradeep, please go ahead.
Okay, we are based out of India, and we are trying to access the market via the FPA route, and we trade the derivative markets in NSE and BSE. Unfortunately, obviously, because of the restrictions, we are not able to access the commodity bullion markets and commodity exchanges in India. I mean, that's the FPA restriction. So is there a way that, is there any, because of the volumes is so high in these exchanges, and we have got many exchanges doing these products, is there any close proximity that these commodities, even at least the bullions, will be allowed in these exchanges through an FPA route?
Yeah, so while this is something which has been under discussion for time, but there is an EFE route which is eligible foreign entities, which is not exactly this, but something to do with the physical exposure. If somebody is having a trade relationship with India and carrying a physical exposure, and if that can be documented and proven as per the regulatory norms, that route is available. But as you rightly said, we are waiting for certain regulatory, further, things as they unravel. So probably your specific modus of entry would get addressed subsequently. But leave us a contact point. We will definitely keep you abreast with the latest.
Thank you.
Pradeep, I mean, see, from the regulators' point of view, I mean, see, gold is not specific to India. It's an international commodity, right? So if you want to trade in gold on the Indian exchanges, as Shivanshu was pointing it out, unless you have an exposure in a physical form, I mean, there is actually no need unless you want to say that you want to trade, right? I mean, so from a hedging point of view, yes, you have an exposure, you can come and hedge here on the Indian exchanges, but purely from a trading point of view, I think the regulator's view is very clear. I mean, it's an international commodity unless you have an exposure. I mean, there is no economic value other than, purely from a trading perspective, Pradeep.
Right. Perfect.
So I'll connect with you offline. I mean, we have.
Yeah.
Okay. I'll give you more insights on this, Pradeep.
Thank you.
Thank you.
Thank you, Nagendra and Shivanshu once again. I think participants benefited from your insights on how the product market is actually unraveling in India. Thank you so much.
Thank you, Professor.
Thank you. Thank you, Professor.
Thank you all.
Thanks, everyone. Thank you, Kechi. Thank you.
Thank you, everyone. So I think now we'll move on to the next session. And I would like to invite Mr. Debjyoti, the AVP of MCX India, to chair the session.
Hi.
Over to you.
Yeah, thanks. Firstly, thanks to IGPC, thanks to the Institute IIMA for this opportunity. And we are slightly behind schedule. So before I start, I would want to know, do we have 1 hour time, or when do we need to end?
Yeah, 40 minutes, totally, both sessions together. 40 minutes, both sessions together.
We have about an hour.
Okay, fine. So we have two very interesting papers today. That 1 second. Yeah, two very interesting papers today that at least I am really dying to hear out the presentations. So I just lost my connection with the papers. Actually, it was in one of the folders. So I think the first paper is by Miss Niharika Sopti, and she, if I remember correctly, would be presenting a paper on the impact of news, the macroeconomic news.
That's right.
On the different market variables, market qualities, etc. So Niharika, please go ahead.
Right. Thank you so much, sir, and a very pleasant good evening, everyone. My name is Niharika, and I'm a doctoral candidate at University of Delhi, Department of Finance and Business Economics. Firstly, I'm very grateful to India Gold Policy Center, Professor Arvind Sahai, Mr. Sudesh Nambiar, for inviting me and giving me this golden opportunity to present my paper within such an august gathering, which has gold experts from all possible arena. And I'm also very grateful to see Mr. Devjyoti Dev from MCX as the session chair, because the paper I'm going to discuss today, sir, is largely centered on the MCX gold futures contract. So with your kind permission, let me begin with my PPT presentation.
Yeah, please go ahead.
So the topic of my presentation and the title really hinges upon the intraday market quality around the macroeconomic news, evidence from Indian gold futures market. So, just to give you a background of it, that why did I choose it and why did I say that MCX gold future contract is the center of study of my paper, is that there's been a unanimous consent both from academia and industry that whenever we talk about Indian gold prices, the MCX gold futures contract has always come to be the leading indicator of it. Now, with that sort of empirical analysis in mind, like what Mr. P.S. Reddy also mentioned, that now let's try move forward with this and understand how our gold future markets behave on an intraday basis. So, in order to understand an intraday behavior, it's also important to understand that how our markets reacts to information flows. Now, that's where I integrate an area called market microstructure with an area called news analytics. So just to give you a brief background that why studying the impact of news on gold is a very, very crucial aspect of a market microstructure perspective and both for policy, is that gold typically is a reactionary asset. So like everybody in the morning was discussing that it's very hard to, value gold. It's very difficult to predict and forecast it. And much of the reason basically hinges upon the fact that it is driven by factors which themselves are very unpredictable, which themselves are very unpredictable. So to give you a sense that most of the complex drivers can go on from fundamentals like demand and supply to macroeconomic state variables to uncertainty to behavior and traditional asset classes. Now, to give us a little bit of a relief, World Gold Council came up with a very interesting, intuitive, web-based formula of gold valuation framework called Quorum, wherein they said that, in order to just have a sense of where the gold prices are headed, you can just see four economic scenarios. You can four drivers. So the first one being the economic conditions in an economy, the risk and the uncertainty factors, the momentum and the opportunity cost. Now, from this very formula, we got a sense that yes, gold prices are driven by huge flow of macroeconomic information. Now, the problem here is that in the recent past decade, we've seen that slew of financialization efforts were done in the context of gold, by which I mean that there was a massive inflow of institutional investments to different products like Mr. Nagendra and Shwanshu were discussing. Digital gold is coming up. ETFs have, got 80% of inflows from the new retail investors. So this particular, move towards financialization has really intensified the way gold prices now will react to market information flows. And more so because spatial fragmentation of gold has also happened, not just across instruments, but also globally across exchanges and also across trading time zones. So this, was studied majorly in the developed gold markets, that commodity prices do have, a sense of predetermined attachment towards what's happening in the macroeconomic aggregates in the US. So, having a sense of it, we thought that let's just try and understand that what are those sources of macroeconomic information to which gold prices react. So what do you mean by macroeconomic information? So one of the sources of macroeconomic information is the public information arrivals. So when we talk about public information arrivals, we say that it's nothing but your macroeconomic announcements coming. There are scheduled macroeconomic announcements and there are unscheduled macroeconomic announcements. So the macroeconomic announcements typically gives you a sense of future state of the economy. So whenever a GDP forecast comes or forecast of inflation is coming, so you get a sense of where the economy is heading towards. That's what makes them a non-diversifiable risk factor. Now, what mixture of distribution hypothesis in our market microstructure literature says that asset prices do react instantaneously to information flows. Now, does that hold true for the Indian gold futures market? That's a bit of a question mark because we don't find any study proving that. Another very interesting thing, when macroeconomic news inflows comes, is that it provides you a natural setting to sort of understand whether our gold products are informationally efficient. So if your gold products are instantaneously reacting to the information flows and reflecting the information, you say it's an informationally efficient product. And do we have an evidence with regard to Indian futures? We don't have it till yet. Also, when we study the intraday reaction to news shocks, it's a bit of a very, very, used method in the industry that a lot of analysts are watching these news announcements and their surprise elements in order to develop news-based trading strategies. So now the bone of contention and the issue comes here is that the direction and the nature of different macroeconomic and news announcements, they are indeterminable a priori. So we don't know that how gold, surprises or surprises coming from unemployment data will have an effect on the gold prices in India. And this makes this study more relevant because it's not a hypothesis testing I'm doing, it's a bit of an empirical issue. We have to really test and see. Another very important dimension in this area is that studies have proven that it is not the announcement timing which is important. Rather, it's the unanticipated amount or the component of the news which is important. And what do you mean by unanticipated news? It is basically the news surprise. So with this sort of a background, we zeroed down to about 3 research questions, which pretty much sums up my paper. The first one is, which type of macroeconomic news moves the Indian gold markets? How does macroeconomic news in terms of global and local news, they affect market quality dimensions of the Indian gold futures? And the third one being, does the Indian gold futures exhibit asymmetric response to bad and good news? So with this sort of setting in mind, let me go forward with the empirical approach. And we just said, what is our novel contribution by studying this? So the novel contribution really lies that we did not so far find any empirical evidence that how macroeconomic news really drives the Indian gold prices. So it's a bit of a first mover that we study this for an emerging gold market. We use an extensive data set both from India and the US to study the macroeconomic news flows. We take up 5 news for which the data sets were available for the forecast and 27 from the US. We study the impact of both news surprises and announcement timings across the 24-hour time. We also see not just the contemporaneous impact, but also the pre-announcement or the lagged effect with a lag of 5 minutes and the post-announcement effect with a lag of 5 minutes. We also not just analyze, in typical news analytics series, we are most interested in seeing the impact on prices and return, but we extend it forward to trading volumes, volatility, spreads, order imbalances, and depth, which gives you a pretty 360-degree view of a market quality dimension of any asset class. Next, what is the news watchers hypothesis is basically what are those macroeconomics news which really moves gold prices, which are being sought after by economic analysts and trading desks. So which are those specific news items which really moves the Indian gold futures market? Do we have an answer to that? Till now, we don't. And so that's a small attempt we try to do. Another hypothesis I'm going to test is called the negativity bias. Now, gold, which is always being touted as a safe haven, it says that does gold, our Indian gold futures market, react more strongly to the negative surprise in the news, or is it symmetrical towards negative and positive news? So again, we don't have an evidence to that in an empirical sense. And lastly, we use high frequency data set for a fairly long recent and long time period, which is 2010 and 18. So now coming up to a quick brush up to the empirical approach we used. We took the MCX gold futures highest volume data. We took the 1 minute stamp interval, both trade and core data from Refinitiv. The sample period is 1st of January 2010 till 31st of March 2018. We resampled the data to 1 minute, and the reason was that in order to work on market microstructure data set, we need to find the optimal sampling frequency. And using some of the volatility signature plots and tests, we found that 5 minute interval is a good frequency to go ahead with. We did bit of a data cleaning exercise to make sure the reliability of the data is in place, and we converted all the data sets to the Indian Standard Time. Now, coming on to the news data, we collected disaggregated. Now, what do you mean by disaggregated? It's the individual macroeconomic scheduled news indicators which Bloomberg gives you. It gives you their release time, it gives you the actual value, it gives you the forecasted value by the analyst. So released the announcement time for India obviously is taken in the IST. For the US release time, we converted all the data time into the IST, making sure that even US faces the daylight saving time, which moves the time ahead by 1 hour. We make sure that all the announcement timings are correctly centered and figured for the Indian domain. Now, coming out to how do you calculate a news surprise index? So there's a pretty standard methodology in which you take the difference of the actual news indicator, the forecasted news indicator, and you divide it by the standard deviation. The reason we divide it by the standard deviation is to make sure that since different news indicators, the GDP might come in percentages, PPI must come in index value, the BOP comes in dollar terms or the INR terms. So we just want to make them all standardized. And lastly, we also calibrated our news surprise index into positive news surprise and the negative news surprise to understand the asymmetric impact. The approach typically was that we took the help of stepwise and OLS regression, obviously with robust standard errors. Since I mentioned that we're going to test it for the pre-announcement effect, that is, what's the impact of a market quality variable at T-5 minutes, and we see the impact of news surprises. Now, the reason I use a summation sign in front of the news surprise is because, and I'll shortly tell you the data for that, that news surprises comes in bunch. They don't come like one news is coming at 1800 hour, other news is coming at 1900. There's a bunch of 15 to 16 news surprises coming at a slew of hour. So it's also interesting to understand that what are those optimal news which really impacts the Indian market quality dimensions. So for the contemporaneous impact, we take the market quality at time t, and for the post announcement, we take it at time t+5. So this is basically the background we're going to move forward with. Now, in order to understand the market quality and its impact, how news impacts the market quality, it's important to understand what do you mean by market quality and how do I define it for my paper. So like people usually say that market quality is sort of a conceptual, word in which you can dovetail the elements related to efficiency, elements related to integrity of a market. And in a crude sense, you basically say that are you able to trade cheap, and are you able to, is that contract or an asset able to reflect the new information quickly or not? So this last sort of a term, that is the contract able to reflect the news instantaneously, is what I'm going to test using the market quality aspects. So the first market quality aspect I use was the trading volumes. It basically gives you a sense of liquidity and trading activity. We took the sum of the trading volume in the last 5 minutes. Depth of the market is an interesting piece of information. So from a limit order book, you get a sense of what are the demand and supply, the buy side orders and the sell side orders. So you take the average of the buy side size and the ask size of the LOB, and you get the depth of the market. So depth of the market also helps you to give the price impact. Are you able to absorb a large market order without significantly impacting the prices? Coming on to spreads. So spreads, we all know they are a reflection of a transaction cost. They give you a sense of the cost of trading, which is again a very significant, important term. And we use it using the difference between the price and the mid-quote into the direction of the trade, whether it is buy or sell, times 2. Coming on to the fourth one, we use volatility because we want to understand the dispersion. So we take the sum of squared log returns for 5-minute interval. Another very significantly important market quality aspect is order imbalance. Now, order imbalance is very interesting because they give you a sense of where is the net buying pressure. So it is the difference between your buy orders minus the sell orders, and they're typically very short-lived. So it gives you a sense of where the gold futures market are majorly dominated with during which hour of the time. And lastly, we also see returns, which are nothing but your log returns at 5 minutes. Now, before jumping on to this question of which macroeconomic news drives, the gold prices, or how the macroeconomic news drives the gold prices, do we have an intuition which is non-empirical in the sense of statistical significance to really gauge and see that does macroeconomic news really should be impacting our Indian gold futures market? So for that, we took a step backward. We went to the basics. We collected the MCX data. We diced the data into average hourly statistics. So please, I would request all the participants to pay attention to this slide because it's going to follow forward. So the x-axis basically defines the trading hours in the Indian Standard Time. So 10 o'clock morning India time, the future starts to trade. 11, 12, and until 2355 minutes is where the Indian futures stops to trade. On the Y side, you have the average hourly trading volumes. What are these stacked bars of different colors? Since we had a huge data set hovering around from 2010 to 18, we thought that not just give you a full sample average, also break it down to a 2-year of averages. From 2010 to 12 gives you blue bars, 2013 to 15 gives you orange bars, 16 to 18 gives you the most recent green bars, and the full sample is 10 to 18. Now, if you all are observing this graph, do you see something peculiar happening? Do you see that suddenly in the opening hour, there is a heightened volumes, which pretty much should be because it's not a 24-hour trading market. So when at 2355 minutes, India stops, there are information flows coming after that also. So in order to incorporate the last night information, you always see a spike in the opening hours. Now, having said and done, we see then again the volume starts to stabilize. But suddenly, the volume starts to rise from 1700 hours until, at least 2000 hours in your time. So why is this happening? What is so unique about these 1700 hours till, which is basically 5 o'clock evening time till 8 o'clock evening time? What's happening in the global gold market? So we got a sense that it is a time wherein the global gold markets, both London, Sheffield, COMEX, are having the highest trading volumes. And the reason they have the highest trading volumes is because of this. So this is the time period wherein you see you have huge amount of inflows in the form of information, news announcement coming. So the light gray bar gives you a sense that India news macroeconomic arrives from 1700 hours to 7:30 IST, whereas the global macroeconomic news from the US starts to arrive from 1800 hours till 1930 hours, and you can just plus 1 hour when you are following a daylight saving time. And we see this pattern across all possible macroequality aspects. You just see for the trades, you see a similar increase in the depth during these hours. For depth, it is even more, visible. For spreads, you see suddenly the spreads are also widening during this point of hour. For volatility, again, we see that volatility is trying to, it really revs up and accentuates during the news time in India and then starts to fall during the US time. Order imbalance gives you very interesting picture. So you see in the morning 10 o'clock until the 1600 hours, you have a lot of buy pressure because order imbalance is buy minus the sell. And suddenly when the news starts to arrive at 1700 hours, you start to see the sell orders dominate. So this is where we see a very interesting influence of news on the market quality dimensions of India. And lastly, we see the return. So even return gives you a sense that yes, the return starts to fall during the US news time. And it pretty much is in the highest domain when the 1800 news hours, 1800 time news time starts to arrive. So with this basic sense in mind, and we now have some descriptives to give us a intuition that yes, you should now go ahead and try and understand that which are those news which are really impacting the Indian gold markets and how are they impacting these market quality dimensions. So we basically got the insight that yes, the liquidity in terms of volume, depth, and order imbalance, it starts to rev up during the news intensive trading hours from 1700 hours to 2000 hours. The spread starts to widen, the volatility accentuates, and you see the dominance of the sell orders. Now coming to the news data, this is how descriptive of the news looks like. The reason we only have 5 pieces of news from India, that's the only piece of news which has analyst forecast. So for us to calculate news surprise, we need both the actual and the forecast element. So you see much of the news are really centered around 1700 hours. The bigger ones like CPI, GDP, and the production coming at 1730 hours. We calculated their frequency, the total number of days in the sample period, the mean surprise, the standard deviation, basically the dispersion in the surprise, the positive news days, the negative news days, and the means thereof. We did the same exercise for US. So just to give you a more clarity on that, just see the release time. There are about 15 newses which are releasing from the US at 1800 hours, which are most dominant ones: personal income, durable goods, GDP, unemployment. They're actually very well tracked by the analyst. Another set of news comes at somewhere around 1900 hours, and then a set of 9 news comes at around 1930 hours, which is India Standard Time. Now, just to give you insights from them, we found from India that WPI has the highest average news surprise index for the sample period. Balance of payment has the highest average standard deviation, And most of the Indian news have a higher number of negative news surprise days than positive. For the US market, on the other hand, we found that the high news surprise indices were basically leading index, construction spending news, business inventory, PMI manufacturing, unemployment rate, whereas the news which had higher dispersion in their surprise index were the following. So it is industrial production, capacity utilization, durable goods sales, personal income, CPI, and the sentiment indices. Now, coming on to the overview of the results before giving you and backing up with numbers. For the first research question, is how does domestic, that is the Indian macroeconomic news, impacts the market quality aspects of the Indian futures? Though we got an evidence that the domestic news have very strong and a contemporaneous and a pre-announcement effect. We also found that the positive domestic economic news negatively impacts the market quality dimensions of India. We also found that what are those news watchers' hypothesis that market moving domestic news pieces are nothing but your BOP, GDP, and inflation, of which we found a very interesting result that news with higher dispersion and news with higher size of news surprise index have a greater impact. On the other hand, the second research question is how does global macroeconomic news impacts the market quality aspects? And we found that it has a contemporaneous and a post-announcement effect. So the US news majorly centered around the contemporaneous and a post-announcement effect. We also found that the market-moving news from US for durable goods sales, personal income, and GDP. And if you recall, we just mentioned these are the news which also has the highest dispersion. So this basically validates both from our domestic analysis and the global analysis that news with higher dispersion and surprise, and also the news with higher size of the news surprise, they have a greater impact. The third question was that does the Indian gold futures market exhibit an asymmetry? And we very gladly we were able to see that yes, from both the domestic and the global evidence, the negative news surprises have a very stronger impact on gold futures. And that really pretty much gives us an indication that our Indian gold futures does provide you a safe haven and a hedging property because they react more strongly to the negative surprises than to the positive surprises. Now, just to back these findings with results, so the first question, like I said, is how does domestic news surprises affect the market quality of Indian gold futures? We did a bit of a regression. I'm only giving you coefficients along with their statistical significance. The T statistics and the adjusted R-square could be taken from the working paper. So just to give you a sense, trading volumes, they say much of the significance or the impact coming from WPI, DOP, GDPs. Similar for depth. Similar, we see much of the contemporaneous impact is for the spreads. For the order imbalance, we also see these are the similar number of news, the GDP, the BOP, the WPI showing statistical significance. And for realized volatility, we only see the BOP and for the returns as well. So pretty much we've summed up the first set of results that it's mostly the market quality aspects have a negative impact. They have high contemporaneous and pre-announcement effect. The size and dispersion of the news surprise does play a very important role, so you should really watch out for it. And the question of which news surprise, we again answered that it is BOP, GDP, and inflation for India. And we also saw that of the 6 market quality aspects, it is the liquidity aspects of spreads, depth, and volume, which are most sensitive to news rather than the volatility and the return part of it. Now, coming to the second leg of findings, that how does global news surprises affect the market quality of India? I'm here only reporting you the optimal regressors. So the results we found out was that the global news have a contemporaneous and post-announcement effect. Interestingly, we observed that it is the 1800-hour news pieces, the 15 news pieces, which have a greater impact than the rest of the news pieces. Also, we found that the simultaneously occurring news, that is, for example, industrial production, capacity utilization, they have a stronger impact on the Indian gold prices. And we also found that much of the positive US economic news have a positive impact on the market quality of gold. That's pretty much because maybe it gives you a sense of higher inflation, which really encourages investors to reallocate from equity to safe havens. And lastly, we also find support from the global evidence that it is the liquidity aspect which are more sensitive and reactive to the global news surprises than the volatility and other aspects. So just to give you a sense of the numbers, these are the optimally significant list of news. I'm not reporting here the coefficient, the statistical significance, just to make sure that the tables are pretty much legible. So we find in the list that for the pre-announcement effect, contemporaneous and post-announcement effect for the trading volumes, we saw that it's PPI, GDP from the 1800 hours, initial jobless claim, From the later part of it, we saw it's the business inventory and factory orders. We saw similar news pieces for depth also, for spreads also, and for the order imbalances and return. So, which gives us a sense that yes, there are specific set of news which really moves the Indian gold futures market. And what are they? They are the ones which have higher dispersion, and they are the ones which are the high size of news surprise. So, one should really watch out for such news. Now, coming on to the last leg of the results, whether the Indian gold futures do exhibit an asymmetric reaction or whether there's a negativity bias, we say, to the bad and the good news. So I think we now have a sense that the good news are the ones which have a positive surprise element and the bad news are the ones which have a negative surprise element. So we did find statistically significant evidence for it, strongly because we found it for both domestic news pieces and for the Indian news pieces. So now to just give you a sense of the numbers. So for the domestic evidence, so we disaggregated our news into positive news dummies and negative news dummies, and we found that the negative news dummies are coming out to be more statistically significant, and the coefficients are also greater than the positive news surprises. And you see that across for volumes, you see that for spreads, for the depth, because I've highlighted them in the light green color. You see that for volatility, order imbalance, and return as well. So it is the negative surprises which really cause jitters in the gold markets. We see this for global evidence as well, because here I'm going to report that all the news pieces are suffixed with a letter called N and P. So these are the list of optimal news pieces which were significant, of which you see majority of the ones are suffixed with N, which gives you a sense that it is a negative news surprises which from the US which are really causing impacts on the market quality dimensions of the Indian gold futures market. And you see that across for all the 6 elements. So just as a test of robustness, we also found that our results are are they stable across the window size? So we did redid the analysis for 1 minute and 10-minute interval as well. What we found interestingly was the 5-minute results are pretty similar to the ones with 1 minute, but when we stretch the window size to 10 minutes plus and minus, we see much of the news statistically significant news pieces starts to become insignificant, which is a sign that yes, our Indian gold futures market are pretty efficient in reflecting the news within the +5 to -5 window, and which is a good signal. So another aspect which I discussed in the first part of the slide was that is it just the news surprise or it is also the news timing which affects the gold prices? So we found that it is not just the it is just the news surprise. What the the asset pricing theories have said, it is the unanticipated component of the news which really which should ideally cause movements in the prices, because as the word suggests, scheduled news pieces, they already are predetermined, time of releases are already predetermined. Lastly, since we had a huge sample data from 10 to 18, we broke it down to 2 years, and we redid the analysis just to make sure that do we find different set of news coming out to be significant depending upon the news pieces. Pretty much the news pieces were statistically similar. So the results can be shown in the working paper. Now coming on to what all of this result really comes down to. So A is that we
Niharika, just to intervene here,
yes, sir.
You wind up. Is this the last slide?
Yes, sir. Yes, sir.
Okay, fine.
Yeah, so just to give you a sense that this sort of news-based trading strategies will help you aid in the develop news-based trading strategies. It will give you insights on the informational efficiency of the gold markets. We can identify market-moving news both from global and domestic sources, and also gives you a sense that yes, it is the size and the dispersion of the news which matters, and our Indian gold futures market does very strongly react to the negative surprises. So this is pretty much a summary of what I have done. I think this is a small effort I made during my PhD work, and I look forward to all your constructive feedback and comments. Thank you all for your attention and patient hearing.
Thanks, Niharika. That was a wonderful presentation. Very novel, very innovative, I must say.
Yeah, thanks.
I now throw the floor open for anybody to ask any questions. If anybody has any question, can unmute and ask, or you can type in the chat box.
Sir, I have one small question.
Yes, please go ahead.
Is there any specific reason for dividing the data into 3 years, like subsamples? So if you have divided, is there any specific reason? On what basis you have divided the data?
So sir, thank you for the question. I think it's a very interesting question. So like in one of the previous slides also, the participant mentioned that if you look at the time period from 2010 to 18, 2013 to 15 was a time period when there was actually the equity bull run. So at that was a time period when gold prices really dipped vis-a-vis the other period. So prior to 2010-12 and 16 to 18 period was pretty much good for the gold. Also, specifically for the Indian market, since we're working on Indian gold, there was too much of government intervention from 2013 to 15 in terms of hike in the imports, in terms of imposition of the CDT. So this was a time period which was afflicted with a lot of government intervention. So we thought, let's just divide and break and see if the impact is waning. Hope that answers your question, sir.
Thank you.
Any other question? So if there's no other question, Niharika, I have one small question, which is,
yes.
Sorry, I probably missed it when you took us through the slides. So between the two sets of factors, which are the global factors, mainly the American factors and the Indian factors,
right, sir.
Is there a sense of how powerful are one set of factors over the other?
So that's a good question, sir. But we need to understand that the news pieces coming from India and US, they're coming at very different time. So the Indian news pieces are coming from 1700 hours 30 typically, and the US news pieces starts to arrive at 1800 hours and henceforth. So it's very difficult to say that which is more powerful in the sense, because when we know that if our markets are efficient, the impact of the news should typically, even a great gross of the scenario should be factored into within probably 30 minutes to an hour, and which gives you a very less sort of an overlapping trading hour to assess that if a news piece which has occurred at 1700 hour in India, will that have a very long lasting impact to the time a US news piece comes at 1800 an hour. So just for the relative sense, it's difficult for me to do that. But yes, but we know from the magnitude, because we are loss of data with respect to the Indian news pieces. You only have 5 news pieces, which gives you a sense of Bloomberg forecast, vis-a-vis 27 news pieces coming from United States. So yes, we do see that United States news, in terms of both numbers and coefficients, they statistically have a stronger impact on the Indian gold futures market quantity.
Okay, great. There is another, if there is time permitting, I'll just have to ask one more question. I just can't go without asking this question, which is about, if you ask a lot of Indian traders, analysts, etc., they would I would tend to think that they would not really consider the Indian factors as significant as the American factors.
Sure.
Yeah. So, but here you have this WPI, CPI, Indian industrial production, etc. So, would you tend to agree if somebody would say that, okay, the effect of these on the Indian gold prices is via some other third factor that probably you would have not explored, something like, let's say, the forex rates or something like that? Which means that the Indian GDP numbers is not directly really impacting the gold prices. It is through other factors which have not been considered
right
here.
Right. No, I totally understand. I totally agree with your point that there is a possibility that much of the news pieces may not have a direct impact in terms of directly impact the gold futures price. But when we talk about gold, sir, we always understand it as a reactionary asset. Now, in the model in which I was working, a typical news analytics based model, we only study the impact of the news price, which itself carries, it's a scale variable, so it's not a dummy variable. It itself carries an information that it is a surprise coming with GDP numbers from India. How does that impact gold? Now, if you say that it's not the direct impact, it's via coming from an FX, or probably there is a factor attached to it, then I would say that our subsample analysis gives you some leads that even if I break our years into different sort of dimensions, because one year was gravely concentrated with government interventions, the other year were pretty decent and good for the gold market. For example, 10 to 12, 16 and 18 again were pretty decent. So even in those cases, we found the results to be statistically significant. So the fact that it's not the direct impact of the news, rather it's a via media. One we could do is we can definitely have control variables and see that even after putting a control variable, does the statistical significance of the news surprises still holds? That's one thing I can definitely extend the paper to. And I thank you for this wonderful suggestion.
Thank you. I think that was wonderful. Yeah. So if there are no other questions, then we would want to wind up with this paper and we'd want to go to the next paper.
Thank you so much.
Yeah. So now I invite Ms. Pranita Wagmare
Yes. Yes.
to
Yes,
present
sir.
paper on is gold investment decision of the Indian investors being impacted by hyperbolic discounting bias
Yes.
during the pandemic period. It's another very interesting, I think, exposition of something I think has not been tested in the Indian gold markets, the hyperbolic discounting bias. So, Ms. Pranita, please.
Yeah.
And if you could
Yeah.
make it in 20 minutes.
Can
Yeah.
you see the screen, sir?
Yeah, we can. One request has come. Could you finish
Yeah.
your presentation by, let's say, 25 minutes or so that we can finish in another 30, 35 minutes?
Yeah. Yes, sir. Yes, sir.
Right. Thank you so much. Your
Yeah.
screen is visible.
Yeah. So, good evening, everyone. This is my paper. Is gold investment decision of the Indian investors being impacted by hyperbolic discounting bias during the pandemic period? Myself, Pranita Vagmare. I am doing my doctoral study under Dr. Smita Shukla in the University of Mumbai. And currently, I am doing my doctoral internship with the Department of Economic and Policy Analysis in SEBI headquarters, Mumbai. So this paper actually focuses on the nexus between the hyperbolic discounting and gold investors' behavior changes in a COVID pandemic period. When you see the data analysis sections, which we have developed the beta delta model to understand the gold investor preferences and the intertemporal choices of the gold investors. So let's quick with the introduction. Gold has a universal appeal and is worshipped in all climates without a single temple, and in all classes without a single hypocrite. It is also it's not only a metal that combines the lustrous beauty, rareness, and the virtual indestructibility and reliable in a value of forever. No other commodity enjoys the much universal marketability as a gold. Gold is not only a reliable on a long-term strategic assets for investment, but
I'm
also
sorry,
an investment option.
I'm intervening, Pranita.
Which
Are
is
you
becoming,
presenting
yes.
your paper? Are you on slide number 2 or something? Because we can see only slide 1.
Yes.
I think you need to put it on presentation mode and go to the second slide.
Yes, wait.
You have to hit escape and then come back.
This is the second slide only, right? Yeah.
Yeah, so now it has come to the second slide. Could you put it on presentation mode so that it's easier?
That is in a presentation mode only, sir. Yeah.
Okay, fine. Go ahead, please.
Now, okay, yeah. So gold is a distinct complement to the stock, bonds, and the broad portfolios. Gold is a wealth store and a hedge against the systematic risks, currency depreciations, and inflation. Gold has a historical improved risk-adjusted returns for the portfolio, delivered positive returns, and provided liquidity in times of the market stress. So the need of the study is like we found that it is very interesting to perceive the interconnection between the volatility in a gold demand during the pandemic and a hyperbolic discounting function. Hyperbolic discount function generates a dynamically conflicting expectations, suggesting an opportunity for the gold buyers to constrain their own potential choices. This paper analyzes the decisions of the gold investors who is motivated by the hyperbolic discounting and has access to incomplete engagement of the processes. So some of the objectives of my paper is to study the impact of the hyperbolic discounting on the gold investor during the COVID-19 pandemic, explore the impact of a temporal discounting. Now the intertemporal choices has the different definitions, and the temporal discounting defined with the future discount time discounting. And understand the different propensity of the investors towards the gold due to the pandemic changes. Also, we studied the investment behavior and gold investment pattern of the hyperbolic gold investors and a pattern of a use of a gold as an asset class. There's some research gap that has become the research problem in my study. I would like to say here, it appears that the gold investors want to invest in a gold ETF during the pandemic. I will explain in the data how it is gone in a different manner, that is in the literature review slide. as they prefer investing in a gold ETF rather than visiting the retail shop and purchase the physical gold due to the COVID-19. However, at the same time, it is also emerging that such investment decision pattern is not consistent, as seen from the gold ETF inflow data over the last few months. This behavior pattern of the gold investor appears to be a indicative of a hyperbolic discounting function. So with the help of a need and the relevance of the study and the research problem, we formulated two hypotheses here. The alternative hypothesis says that the hyperbolic discount bias has an impact on the gold investors, and null hypothesis is the hyperbolic discount bias has no impact on a gold investors. While studying the existing literatures, the hyperbolic discounting are dependent on three different parameters. First is the intertemporal choice. Here, important in an intertemporal choice. In a most future consequences. So that's the reason intertemporal choices is important while making any kind of a decision making, because this decision making involves the trade-offs between the cost and benefit occur in a different time period. So it might be, for example, some decision has immediate benefit and a defer cost, or some decision has immediate cost and defer benefit. The second parameter of the hyperbolic discounting is a time discounting, which gives the scope to the time preference, which also depend on the time inconsistency. Here it might be here the time is discounted because here we are checking the patience and the impatience level of the investors. If the investors are impatient towards getting the rewards, that means they want immediate gratifications through the reward. If the investors are patiently behaving towards their return, that means they want a delay in a gratifications. It means they are handle their patience level very smoothly to by getting a reward. Okay, this I have studied, I have learned in a hyperbolic discounting existing literatures, and some data which I have jotted down from the associations of the mutual fund, World Gold Council, and the SEBI bulletin. That is, I wanted to quote it here. The WGC report that which define the demand for the jewelry decrease in the second half of the 2020. That is 74%. And also it's shown the total supply decreased by the 91% of the April and June 2020. It means the physical gold demand has been decreased, and they wanted to even the gold ETFs, as I have studied the associations of the mutual fund in India's report, that in the first 7 months of the year 2020, the net inflow in the gold exchange traded fund, that is ETF category, reached rupees 4,452 crore as reported by the MFI. At the end of the July 2020, the asset under management of gold ETF increased by 19%. That is rupees 12,941 crore from the 10,857 crores. It clearly shows that the gold ETF demand has been increased, and this easy to purchasing online played an important role in the investors' behavior during the lockdown. It means what? The behavior of the investors toward the during this lockdown period toward the digital gold and the gold ETF has been changed. It has irrational behaviors. So this point I would like to mention in a literature review. What kind of a research methodology we have considered during this paper? The research has been undertaken to study the impact of the hyperbolic discounting bias impacting the gold purchase and investment decisions in a Mumbai region during the COVID-19 pandemic. The study incorporates both primary data as well as the secondary data. The sample design is based on the convenient sampling method. The sample is proposed study proposed study is non-probability sampling. The primary data, around 230 questionnaire we have distributed among the Mumbai region, get the respondents, and after scrutinizing the data, 201 responses we found valid for the study. The secondary data, as I have mentioned earlier, that so many research papers, we have studies, and the government bodies, whatever the data is available on the public portal, that I have studied for the secondary data here. The data analysis. Here we have asked the question to the respondent that to rank the 7 investment alternatives. We have given them the options like a real estate, mutual fund, debt instrument, equity insurance, physical gold, and the gold ETF. I have considered here only physical gold and a gold ETF to study how the patience level and impatience level towards the gold ETF and a physical gold of the gold investors. And the data collected, these responses are 2 situations. That means the intertemporal choices, that is a time inconsistency.
Sorry,
Yes.
are you taking questions just now, or you'll take them later?
Okay, we'll take that later, sir.
Yeah, let's take them later.
Yeah. So the study collected this response for the 2 situations. First is a normal economy and a economy impacted by the COVID-19. The hyperbolic bias, that is, we have considered the quasi-hyperbolic discount function to understand the impulsivity of the gold investor towards the choices between the gold ETF and the physical gold, which is also called as a beta delta model. Now, this is the data which I have considered here to understand the beta delta model. Now, this is the formula which I have considered here, beta delta function model, that is U utility is equal to U base plus beta delta utility 1, where the utility U is the utility of a gold investors invest in a gold ETF or a physical gold. Beta we have considered here 0.5 because it is always considered as a less than 1, which represent the present bias. Now, present bias is the bias where we can consider, we can understand the investors and how the investors are taking the decisions, and when the present circumstances are affecting the decision making of the investors. So present bias is important in the hyperbolic discount. Delta 1/3 weight given to the future value, that we have considered 0.67. The delta represent the discount factor which captures the time preference of the gold investor to understand the patience and the impatience level. And the normal economic situations and economy impacted by the COVID-19, these 2 situations represent the time inconsistency. Now, each rank-wise data means what? This each rank-wise data which we have collected, we have applied in a beta delta model to understand the utility of a gold investor, whether they are giving the preference to the gold ETF or a physical gold. So we have calculated the rank-wise data. Here is a calculation of a beta delta model. As you see, the count of a first rank means what? The respondent, we have given them 2 choices. First is a economy impacted by the COVID-19 situation and in the normal economic situation. The 19 respondent are giving the first preference to the gold ETF, and when the COVID-19 situation, and in the same period 46 people they are giving the first preference to the physical gold. And in a normal economic situation, 21 responses are given the first rank to the gold ETF, and 51 respondent given they are giving the first preference to the physical gold. This collected data we are incorporated in the formula, that is the beta delta model formula. The base is here a COVID and the non-COVID. In the COVID situations, we get the 34.41 value, and the non-COVID situations, we are getting a 38.085 value. Now, in every count, I have formulated this formula, determined the formula, and we got a different result for a first rank, second rank, third rank. Means what? The responses are given to the first rank to the gold ETF for a physical gold. So till the 7th rank, because we have given the 7 choices to them, whether they are giving the real estate first choice or not, like that. So first to 7th rank, I have calculated the beta delta functions over here, and I get the different values. Now, when the beta delta value are higher, that means we are checking the patience and impatience level, whether the time inconsistency affecting the gold investors or not, whether the gold investors are getting immediate gratifications, or they wanted to hold their patience and they are satisfied with the delay gratifications. That we are analyzing through this data. What exactly this means? If you see the count of first, second, and 5th rank, the higher value of the beta model due to the impulsivity towards the intertemporal choice. The gold investors were patient and prefer the physical gold. Here, gold investors are liable to have the delay gratifications because they are satisfied with the physical gold. They don't want to explore the gold ETF. Okay. But by contrast of that, the respondent also gave the preference to the gold ETF when they consider as a gold ETF as a liquid asset. When we see the rank count of a rank 3 and a rank 4, the higher value of a beta delta model, because of the time inconsistency, gold investors believe that the things in the normal economic situation do not
Pranita,
give much gratifications.
Pranita,
Yes,
I have to interfere here. Yeah, could you just wind up and go to the next?
Yes, sir.
Just skip the technical part and go to the implications part.
The last is implications only, sir.
Right.
Here in my result and conclusion, that I am concluding here that the hyperbolic gold investor preference choices may differ because what? The respondent are giving the preference to the gold ETF. Why? Because the beta delta value is higher than the given. And in a COVID situations, we are getting a 84.085 and 52.05. It means the respondent having the immediate gratifications because of the time inconsistency at the most one of the parameter present buyers are affecting. That's the reason the respondent here giving the preference to the gold ETF, and they are seeing the gold ETF as a liquid assets for their investment. It can be the good portfolio for them. But at the same time, the responders are also in a normal situation. That means non-COVID situation. It means a normal economic situations, people prefer the delay gratifications. The intertemporal choices can be differ. It can be irrational. So the present buyers are not affecting here, and that's the reason physical gold are preferring by the respondent. And in the non-COVID situation, they sees as the physical gold as a liquid assets. In the count of a 6th and 7th rank, respondent indicates that they are impulsive towards both the situations, COVID situation also and non-COVID situation also. That's the reason we are getting the number of a similar here respectively, like 12.35 and 10.675. So hence the intertemporal choices could not be defined clearly because they are not clear in their intertemporal choices. The time inconsistencies are not affecting, or it might be affecting in the future also. So it will be it is not clear that the intertemporal choices can define as clearly in the count of a 6th and 7th rank. Here the study is concluded. This diagram you can see here. The study is concluded that the hyperbolic discounting bias has impact on a gold investment behavior during the COVID-19 pandemic and the normal economic situation. We found that the respondent react spontaneously while making intertemporal choices, and they are considering the gold ETF as a liquid asset during the COVID situation, the physical gold as an illiquid asset. The present bias has been tested positively on the data which we have collected. Hence, the study accepted the alternative hypothesis, that is the hyperbolic discounting bias has a impact on the gold investors, and we reject the null hypothesis. The paper has the authentic study to understand the changing pattern of the gold demand, physical gold and a gold ETF demand during the pandemic. Henceforth, there is a gold investment needs, but it has an impact of a temporal discounting. So we can consider that the gold investors are influenced by the present bias. Hyperbolic discounting bias has impacted the preference choices of the gold investors. I wanted to consider the gold bond also, but we have found that the gold bond has a very aggregate amount, and there is no a big difference between the physical gold and a gold bond and a gold ETF. As we have seen, the gold ETF has again, Mr. Nagendra Kumar has said that the 80% of the just now he mentioned that 80% of the investors are newly invested in a gold ETF. This data shows the irrational behaviors of the gold investors, and which is a perfect example of the hyperbolic discounting over here. Because of the time inconsistency, 80% of the investors, 7.2 lakhs of the investors, they are investing in a gold ETF because they want a immediate gratification. They can't hold their patience level, and that's the reason the study of the hyperbolic discounting bias is important in a gold investors' preference choices. Thank you, sir. I'm winding up here.
Thank you. That was quite an interesting paper. So I think we have a question from Professor Sahai.
Yeah, Pranita, can I ask you to go back to the slide where you showed the data collected and the pandemic and non-pandemic data?
This one, sir? Yeah.
So 3 or 4 questions here. The first one
Yes,
is,
sir.
how did you collect this data? So you had, I think, 201 valid responses, right? So I'm assuming that
yes, sir.
You asked people online for this data?
Yes, sir.
And you showed them on the screen a choice.
Yes, sir. I have given them the 7 ranks. Whether they are giving the first rank to the real estate or a mutual fund or a gold ETF or a physical gold. Like I have given the investment instrument choices. Okay.
I understand that. My question is somewhat different. My question is, so this one person who is kind of ranking these 7 choices, that same person is shown the option of a normal economy and then
yes,
impacted by COVID, or these are different people?
No. The same person are giving the 7 ranks in a 2 different situations.
In both the scenarios. Okay.
Yes, sir. Yes, sir.
Have you actually collected any data where you have tried this with different people?
Not yet, sir.
No. The other point is, I just want to hear your thoughts on whether you think that asking that same person between their first response to normal economy and their second response to economy impacted by COVID, was there any gap in time? Did you have some other questions in between?
Yes, sir, because I think it's a valid question, sir. Because at the same situation, how the one person reacting in a normal economy and how the same person is reacting in a economy impacted by the COVID-19. That is the hyperbolic discounting bias, sir.
Yeah, I understand that.
Yeah.
My question is more from a data collection perspective.
Okay.
This is kind of in the kind of research that I do, behavioral experiments where
yes, sir.
within subject design. Now, this may not be a point of focus or attention for a beta delta model that you're trying to conduct, but it does has to do with the the robustness of the data that one actually gets. So simply curious as to how you had collected the data. Thank you for your response.
Yeah, thank you so much. Yeah.
Quickly, could you just throw some light on one question which has come, which is about your sample size being 201. Can you clarify the sample size for research study which you have undertaken during COVID? Because I think the total is showing a different number in this table.
No. That is why the total is showing a different number, because one person is giving the 7 choices. It means the one person is giving the 14 choices. 7 choices for the normal economy and 7 choices for the economy impacted by the COVID-19. That's the reason the number is showing that that way.
Okay.
Yeah.
Okay. Okay. I think we don't have time for any other question, except I have actually a small question. Again, a clarificatory question. So you have taken gold ETFs as the instrument, as the proxy for immediate gratification, and
yes, sir.
Physical gold for a patient.
Yeah.
This one. I mean, why is that? I mean, what is the logic behind this? Because I believe both are equally liquid. Both can be easily bought and sold. That is the normal impression.
Yes, sir. But when any individual purchase a physical gold, they are more inclined towards the delay gratification, sir, because they don't want a return on that physical gold immediately, right? Because they are seeking the physical gold as a long-term investment, not the short-term investment.
Okay.
That's the reason I have considered that a delay gratifications for the physical gold.
Okay.
I would like to consider the gold bond here, but I have the sample and I didn't get the good response for that thing. That's the reason I switched to the physical gold and gold ETF. So yeah.
So thank you. That was a very good exposition again. And so we wind up this session, and I think both the papers have been very good.
Thank you, sir.
Professor Sahai, Mr. Sudesh, thanks. And I think we conclude the session here and move on to the next session. I think the next session will be only tomorrow.
Sorry?
The next session will be tomorrow, right? Or do we have a session now?
Yeah, I'm just wondering whether it is on this link or some other link.
Okay.
It's on the same link.
So we can invite Terry Heyman and Tyler and Ankur Goyal to this, right? I think I saw them over here. So
Terry's here.
Hi.
Hi, everybody. Good afternoon.
Good afternoon,
Professor
Terry. Good afternoon, Tyler. Good afternoon, Ankur. So sorry, we are running about half an hour, 40 minutes late. My apologies. I am very conscious that we might be running into your lunch time. So I think I have just decreased my popularity index by perhaps a certain amount. And I will make it up for you, Terry, whenever we meet. And I hope that is soon with a lunch that will be on me.
Can I just say first? I mean, I would very much. Can I just say first? I mean, I would very much look forward to that. And meeting in person.
Hello.
Have actually been very, very considerate in allowing me to finish watching the day's cricket before we got started.
You're very kind. You're very kind, Terry. We have a session where we are going to be getting two perspectives. One is on the increasing relevance of ESG policies for success of gold and jewelry business. This is an increasingly important area. ESG, the governance part especially interests me. So I'm really looking forward to what you will be sharing with us. And then we have the OECD responsible sourcing guidelines. So without further ado, let me hand over to Mr. Terry Heyman, CFO of the World Gold Council, and look forward to your talk, Terry.
Thank you very much. And thank you again for the invitation and the opportunity to speak today. It really is an honor, and had some fascinating talks already. And I look forward to talking about gold from an ESG perspective. And I think this is an area that's becoming increasingly important. both with the global investment community and also increasingly with retail investors, be it buying bars and coins and jewelry. And I think we're going to see that ever more over the next few months and years. So I have some slides. Let me put these up and hopefully everybody will be able to see. So I'm going to spend a little while today talking about the increasing relevance of ESG policies for success of gold and jewelry business. I'm going to talk more about what's happening at the global level. Very happy when we get into Q&A to address some of the more specific Indian questions that you might have. And it won't be a surprise to anybody, I don't think, on this call, that there is increasing interest in ESG investing. We've seen headlines for a while now around the increase into investing with an ESG focus or an ESG lens. And actually, one of the most remarkable trends during the pandemic has been the additional attention this is focused on ESG and sustainability investing. I think investors across the world have recognized that we have a collective responsibility to look after our planet and look after our people. And that has actually helped ESG become even more mainstream, and the amounts of funds that are now being directed into ESG type investments has really accelerated hugely over the last year. And there are lots of different ways to look at that. And even this morning, figures coming out just in the UK retail market showing that it's not just the big institutional investors, but it's retail investors as well. And so I think for the gold sector, this has some really important lessons in terms of it's going to be increasingly important for the gold industry to be able to demonstrate why gold can be thought of and considered as an ESG investment. Again, be that in bar, coin, jewelry, investment in gold miners. But obviously, for that to be credible, there needs to be action taken. And I'm going to talk today a little bit about what the gold industry is doing, certainly with a focus on gold miners. And one of the things that I think it's important to be aware of in all of this is that there is an increasing movement towards, if you like, just divesting from certain sectors that are perceived to be not credible from an ESG perspective. And I put this ad up because I think this is really taking it to an extreme. But there's a very long list of sectors that this company are saying we're not going to invest in. We'll not invest in any of the following sectors: aerospace, defense, brewers, casinos, gas, electric utilities, metals and mining, just to give an indication of where this might head if we collectively as an industry don't both improve our ESG performance. And again, I think there's already lots that's happening there that speaks to good ESG performance, but also importantly, communicate why this is a sector that is credible from an ESG orientation. So delighted that the people are aware of the World Gold Council and what we do. And I'm sure many people know what we do in an Indian context. Just to make it a little bit more global, we are, as I think people are aware, a membership organization. Our members are the world's leading gold mining companies, and they really do represent the bulk of publicly listed large-scale gold mining companies in the world. And our board comprises generally the CEOs from these companies. And this whole topic around ESG and sustainability has been really important to them, individually as gold mining companies, and collectively representing the board of the World Gold Council and the gold mining industry. And it's an area of work that we at the World Gold Council have really been increasingly focusing on over the last few years, recognizing that this is a critical issue for the industry to speak to address, but also, really importantly, that this is an industry, and I'm talking actually here about the entirety of the gold supply chain, that contributes so much in terms of social and economic contribution. And it's important that that is understood and communicated, as well as the steps that are taken to minimize ESG risks. And so a key initiative in this whole area is the Responsible Gold Mining Principles. And this is a set of expectations, principles, a framework that defines responsible gold mining. This is an effort that we were asked at the World Gold Council to undertake on behalf of our members. We actually started on this back in 2017 and spent 2 years developing this set of principles, going through a very extensive consultation process with external participants, with civil society, with government, with members up and down, with the companies up and down the gold supply chain. And actually in September 2019, so getting on for a year and a half ago now, set out this set of 51 individual principles grouped under 10 overarching themes under environment, social and governance, and I'll come to those in a moment, that really does define, we believe, all material issues, ESG issues associated with gold mining. So what this means is that the market can have confidence that if they are sourcing gold from a company that is in conformance with these responsible gold mining principles, they know that that gold has been responsibly mined. And it really does reflect the commitment of the world's leading gold mining companies to operate responsibly and to pass on that assurance to the downstream supply chain that this gold is being mined and produced in a responsible manner. And I should say, this initiative has been led by members of the World Gold Council, but it really is intended to apply to gold miners across the world. And we hope that it will be adopted by all gold mining companies. And indeed, we've seen some encouraging signs. So let me just briefly talk about what this covers. And I'm not going to go into detail. There is a lot of detail behind this, and I'll encourage anybody that's interested to go and look on our website. One of the objectives in setting out these principles was to make it accessible and to make it pretty easy for anybody to pick this up and understand what it is that gold mining companies are committing to when they sign up to these responsible gold mining principles. But we've grouped them under environment, social and governance. We actually chose to start with governance, and I think as talked about the importance of governance and understanding governance. If you can't get your governance right, it's really hard to manage the social and the environmental side. So in governance, we've got an umbrella principle around ethical conduct, really a very straightforward place to start in terms of committing to operate responsibly and what that means. Around impact assessment and understanding the impacts. Many gold mining operations are found in remote communities, and they are such a big center of economic activity and indeed social activity that they can have outsized impacts, and really important for them to understand that and monitor and mitigate. And supply chain, and that's particularly around the supply chain for a mining company, but it does extend to downstream supply chains and what it means in terms of managing the governance of those interactions with supply chain participants. In the social category, we look at safety and health, always important in the mining industry, particularly important during the last year in the pandemic. And there are actually many great examples of mining companies really helping support local communities manage their community health through everything that we've been through in the last year. Human rights and conflict, again, an essential aspect about running a responsible mining operation, and certainly reflected by so much of the work that the OECD and others have taken on, looking at potential linkages between minerals and severe human rights abuses, and important that all gold mining operations are responsive to that. Labor rights and treating the workforce in the right way, and working with communities. And actually said that there are 51 sub-principles. So each of these umbrella principles has a number of sub-principles. There are more under working with communities than any of the others. And I think that reflects the importance for a mining company to engage with the local community and work with the local community. And quite simply, if you don't have the support of the local community, it really challenges your ability to operate over the long term. And frankly, it challenges your economic model. And then under environment, we look at environmental stewardship. So really taking care of the environment around the mine site. Biodiversity, land use, mine closure, thinking about managing the land over generations. And as people on this call will know, mines do have a long existence. The resource is where it is, and you have to operate in that place. And it takes a long time, often 30, 50 years and more, between initial exploration activity to building the mine, to closing the mine. And then finally, but really importantly, water, energy, and climate change, and operating responsibly in all of those areas. So I've just gone through that very briefly. Again, there's a lot more detail. And what is required is not just that companies put in place these principles, but they actually get external assurance and they disclose publicly how they are conforming. And an important part of all of this and the responsible gold mining principles is supporting this belief that we have very strongly that when undertaken responsibly, and again, we think the responsible gold mining principles define what that means for a gold mining company, gold mining, and indeed I would say the entire gold sector, contributes significantly to social and economic development. And I'm sure you'll recognize the icons on the side of the screen here. These are the 17 goals set out in the UN Sustainable Development Goals. And to me, these are two sides of the same coin. It's really important that the gold sector as a whole operates responsibly and clearly sets out its stall as to what we mean by responsible business practices. I've been talking a lot about responsible gold mining, but I would also say it's important that the refining sector, that retail, that downstream fabricators also operate responsibly, and that this industry helps communicate and understands the important role it plays in supporting sustained social and economic development. And I want to talk a little bit more about that now. So just going to pick a few examples. SDG 17 talks about global partnerships. The gold sector is excellent, really excellent at creating partnerships. And here's just one example: fighting malaria in Ghana. And AngloGold Ashanti, who are a leading South African-based gold mining company, have significant presence in Ghana. And they actually have been working over a number of years to support community health, and with a particular focus on malaria, which is very prevalent there, both because it impacts their operations. They were losing a lot of time to people being sick from malaria, but also because it's the right thing to do. And actually, they bring in capacity, they bring in expertise, they can help the community. And actually, what you've seen is the Global Fund for AIDS, Tuberculosis and Malaria, a global organization supporting community healthcare, actually gave a grant to AngloGold Ashanti to expand the scheme because it was so successful. And that to me is an example, a great example of how partnerships between mining companies, communities, local governments, and indeed international organizations can really help support these SDGs. Another example, there's been a lot of focus, quite rightly, over recent months and years on gender and the role that women can play in helping support greater inclusion. And a few examples here about how the mining industry is looking for those opportunities to encourage women. And I'll give you a little anecdote. You see this lady here, she's up on one of these big dump trucks. These dump trucks are hugely expensive. It's one of the biggest expenses to running a mining operation. And actually, the cost of the tires, these tires are $50,000 a tire. So managing these tires and managing wear on these tires is really important to the bottom line. And companies track drivers and how good they are in being, just like Formula One drivers, how effective they are at minimizing wear on tires. And it's been repeatedly shown that women are much better at minimizing wear on drivers. And you now get lots of companies building up these schemes to promote women driving these huge dump trucks, and they really are enormous. and many women haven't necessarily even ever driven before, but they're given training and they prove to be excellent dump truck drivers. And that's just one example where there are real opportunities to increase more gender diversity in the mining sector. And I think it's an important area that the mining industry is committed to and continuing to work on. And then last example, just on one of the SDGs, is looking at biodiversity. And often there are criticisms of the gold mining sector that it comes along and it creates a big impact and it digs a big hole and it changes the natural landscape. And some of that is true, there's no question. This is an extractive industry. It does create change, but actually that has a potential to improve things. And if it's done in the right way, and I stress that, done in the right way, there really is the potential for mining companies to be great stewards of the land that they're using and actually promote diversity. And there's some examples here about the lengths to which gold mining companies have gone to actually promote diversity, biodiversity, by recognizing that a healthy environment, it supports, again, their long-term operations, and that through focused effort and attention, you can actually see increased biodiversity, whether it's protecting local fauna, by improving the agricultural conditions, by creating additional protection. And you often see that mines actually want to create buffer zones around them. So they look to really support the land use in the broader area. It's in their benefit, and planting trees and actually improve biodiversity. So I've just given a couple of examples, but I think important to understand the role that responsible gold mining can play. And again, we put out a report last year looking at this, and it goes into a lot more detail. Again, that's up on our website, and would encourage anybody that's interested to take a look. And then very briefly, because I know we're running out of time, climate is a really important issue to investors globally. I think we see that certainly big investors focused on the long term. We can't have a conversation now with central banks and sovereign wealth funds without talking about climate change and the impact of gold and climate change in the horizon, the investment horizon that those institutions have. They have to think about climate change. And so we've done some work looking at the impact from an emissions perspective of the entirety of the gold sector, including the jewelry sector and fabrication. And actually, what is interesting here is, unlike almost all the other commodities, the bulk of the emissions are associated with mining and milling, the upstream part. There's very little in downstream, albeit there are opportunities everywhere to improve. And so what that means is, if you can reduce emissions at the mining and milling phase, this is an industry that has the potential to get to net zero emissions in line with the Paris Accord. And we're seeing, with declining costs of technology, that there really is a pathway here to get to net zero. It's challenging, but this is an industry that is a big, heavy industry that does put out a lot of emissions. But importantly, there's real opportunity for decarbonization. And just to quickly talk about some of the things we're seeing in the decarbonization, the world's first all-electric mine is a gold mine. It's Newmont's Borden mine in northern Canada. No diesel, no heavy fuel oil, completely runs electric, including an electric fleet of vehicles. We're seeing the deployment of huge solar arrays that not only power the mine site, but power local communities in some parts of the world, in particular in West Africa. And the IIMA Sekane mine in Burkina Faso is a great example. There's lots of land near the mine site, so they have room to put out these big solar arrays. It's flat, there's lots of sunshine. They're really at the leading edge, not just within the mining sector, but globally. Increased use of hydro and others. And I think this is an exciting time, actually, to be involved in the decarbonization sector and understand the impact and the potential there is in the gold sector. And a final point, I've talked quite a lot about what's happening in the supply chain, but actually, we think there's going to be an interesting case to be made for gold itself to be looked at as an asset that can help diversify investors' portfolios and provide not just risks as we understand it today, but risks going forward, in particular in regards to climate change. And as you think about the world under different temperature scenarios, and we all hope that we stay well below 1.5 degrees in line with Paris, but as the world does heat up, we're inevitably going to see fluctuations and volatility across asset classes. And actually our initial research, and it is initial, and this is an area we need to look into further, demonstrates that gold is likely to be much more resilient to both the physical and transition risks than other asset classes. And increasingly that is going to be an additional reason why people will look to hold gold. In a world impacted by climate, there's going to be a lot of volatility in terms of investments and asset pricing, and gold is likely to be more robust and indeed therefore become an ever more important part of an investor's portfolio. So I hope that's been a helpful sort of scanning of the landscape. Very happy to stop there and take questions if there are.
Thank you so much for that very illuminating presentation, Terry. Open to the house for questions. I think there was one comment from Anil Kansara. The comment is essentially saying procurement from ASSM is a challenge to meet ESG requirements. Mr. Kansara, Anil bhai, do you want to elaborate a little bit on that?
All right, well, I can see there's a question there around ASM, so let me speak to that. Yes, absolutely. There is, ASM is an important part of the gold market. Gold mining from ASM contributes somewhere in the region of 15 to 20%, potentially even more than that, into total global supply. And it's really important that the gold sector looks to find ways to formalize that gold coming into the gold market, that we create opportunities that gold can enter into the marketplace, but importantly, that gold mining is undertaken responsibly. And there are a number of schemes that are looking to support responsible ASM production. Swiss government has been very involved in one initiative, the Swiss Better Gold Initiative. Fair Trade, Fair Mind are other examples. I see Tyler is on camera and will come and speak about the fabulous and really important work that the OECD have been doing in this regard. So yes, there are undoubtedly challenges associated with ASM, and unfortunately, too much ASM is undertaken with poor practices as it relates to environmental, social, and governance considerations. But there are encouraging signs, and there are a number of programs that are supporting good ASM practices, and the entirety of the market should look to support those.
Thank you so much for that response, Terry. So I guess since we are running somewhat behind, we'll move on to the discussion that we have between Tyler Gillard and Ankur Goyal. I want to take this opportunity again to thank Mr. Terry Heyman, CFO of the World Gold Council, for taking the time today to share with us those views on ESG. From many different perspectives, one has seen ESG become a lot more important, not just in the gold industry, it's now happening across the board. So it's a very, very important part of our future as well here in the gold industry. So over to Tyler Gillard and Ankur Goyal. So we have about, shall we say, 45 minutes, Tyler and Ankur. Perhaps I can invite both of you guys to take a shot along with Harish Acharya. Maybe Tyler, if would 20 minutes be okay? 25 minutes, 20 to 25 minutes?
I don't need that much time. I have some slides, but I'm happy to leave time for conversation, I think is most important.
Great. And then Mr. Ankur Goyal and Mr. Harish Acharya, Vasubhai, about maybe another 20 minutes between them. And then we'll open it up for conversation. So please go ahead, Tyler.
Thank you very much, Professor Sahay. And it's very nice, well, to virtually see some of you today. I hope you all have stayed healthy and your families as well in this uncertain times. I'm just going to share my screen so that I can get going. Excuse me, so you can see some of my slides. Oh, excuse me. Okay, so I'm going to reflect. I was asked to reflect on sort of where we have come in the last 10 years and really where we need to still go on responsible sourcing. And I'm really pleased to be following this presentation with Terry's, because responsible mining and ESG, the rise of ESG and responsible sourcing are two sides of the same coin. They're like a glove. And I think we would share the view, just taking a step back, that investors around the world are seeing the value in responsibly produce and responsible business conduct. Around the world, we've seen around $35 trillion in assets that have been dumped into ESG funds or ESG tilted funds, and that has doubled in 2 years. And this is not just because the market sees this as, you know, nice to have and ethical, it's the right thing, but this is also shows the market believes that these are resilient investments. And that, I think Terry really demonstrated that very well, whether it's around climate risk or avoiding market disruptions around security of supply. Responsible business conduct is a market risk. It's a resilience risk. And I think that's also why I'd like to applaud, before I start, I'll get into it, really the leadership of the National Stock Exchange in India and also MCX, and adopting these requirements and seeing that this is about protecting market stability as well as doing the right thing. Now, I joke, but I'm sure you all sleep with the OECD guidance under your pillows every night. So you really know all this stuff back to front. But just to recall that the OECD guidance is a standard that applies to actors from mine to consumer, with each actor having a complementary responsibility to do due diligence. So what a miner does is different than what a buyer and a trader does, which is different than a refiner and different than a jeweler. That's the starting point. It links very well to what the responsible gold mining principles of the World Gold Council, because of course, if you're sourcing gold and you know that the production has been done responsibly by a miner, your job is easier. And I think that's one of the drivers of what the World Gold Council has done. And, you know, we worked really closely with Terry back in the days to say, look, if our gold miners do this stuff, it will reduce the burden on the refiners themselves and make our gold more marketable. The OECD guidance focuses on some of the most severe risks. So Terry presented all the environmental, social, human rights issues, which the OECD believes are of critical importance in global business. Since we're taking a supply chain angle and we're asking business to look in their supply chains, we focus on the most severe issues, which is about support to conflict, non-state armed groups, serious financial crime like bribery, money laundering, terrorist financing, severe human rights abuses, including worst forms of child labor and forced labor. Importantly, the guidance really and due diligence as a sourcing concept is all about progressive improvement. There's no possibility for perfection, and we had the question on artisanal mining is a perfect example. OECD believes very strongly in the value of artisanal mining. This is a provider of jobs for tens of millions of people worldwide, critical job provider. We don't want to take away those jobs from artisanal miners, and we don't want to take away those jobs from small dealers in gold. In fact, we want to support the growth of those jobs in the long term. So progressive improvement, not expecting perfection, but making improvement year on year is the core undercutting principle of what we mean here. So here's a quick, a little brief overview of the last 10 years. Of course, it doesn't cover everything, but it shows a little bit of the evolution. So the OECD guidance was adopted in 2011, but it was actually negotiated in 2009 and 2010. And in fact, that's why pre-2011, you already have some very high-level political endorsements of this standard as a global reference for sourcing from the UN Security Council, from Central African countries as well. We developed this standard hand in hand with business and civil society. So business across the supply chain. Terry was there representing the large scale miners. We also have refiners and smelters as well as jewelers at the table. In 2012, the United States adopted Section 1502 of the Dodd-Frank Act, which was originally supposed to be a piece of legislation aimed at market stability after the financial crisis, but it included this sort of miscellaneous provision around sourcing from Central Africa and requiring large publicly listed companies, often on the downstream side, so electronics and jewelers, to undertake due diligence on the source and chain of custody of their metals for tin, tantalum, and tungsten. That's called the 3 Ts, and gold. The US SEC, Securities and Exchange Commission, mandated those companies to use the OECD framework in conducting due diligence. So it's a legal requirement for the largest listed companies in the United States right now. And that was adopted in 2012. I would say the first sort of 3 or 4 years really focused on gold and 3 Ts from Central Africa, our work. That was really the impetus for the start of our work. But since then, and particularly since 2015, the work has expanded considerably to include other jurisdictions of gold origin, also to include other metals like cobalt and other base metals. So I know I know that the OECD guidance has an OECD logo on it, but it's important for us to emphasize here that it is truly a global work. We would not be here and be able to have any legitimacy or credibility if we only worked with OECD countries. This was adopted by producing countries, the standard, and in 2015 and 2016, it was adopted by the Chinese industry and the Chinese government through our cooperation with them that was included in our high-level program of work agreed between our Secretary General and the Chinese Premier. That standard Chinese due diligence framework, which is aligned with the OECD framework, was adopted in 2016 and has also become a market requirement for the gold industry there. In 2017, another big important marker on this timeline is the adoption in Europe of a regulation on due diligence for responsible sourcing in tin, tantalum, tungsten, and gold. That regulation applies to importers of metals and ores, and there's a legal requirement for importers to undertake due diligence in line with the OECD when sourcing. So I think one of the things you want to see here in this evolution is that with the growth of this originated in something that was very much focused on promoting investment and trade in conflict areas, and now has become sort of a de facto market standard. And at the end of this, and I'm going to get into it more, of course, we have some positive news coming out of India last year. The National Stock Exchange really following up on their commitments that they made earlier in 2019. Some of the biggest drivers of responsible sourcing, we spoke about those drivers already with Terry. Terry mentioned, there's a real clear market driver. There's a market demand for this. And that's because we really believe that responsible sourcing creates stability in the markets. It can help protect against price volatility and volatility related to security of supply. It can open up new markets and create secure access to new markets. And it can protect, most importantly, as well, against legal and reputational risk, which has a whole host of other issues. So our real focus has been on working with industry programs to adopt these in major global exchanges and market makers. And I think we've really achieved that. In 2016, we assessed the alignment of some of the biggest industry programs, notably the LBMA, the DMCC, the Responsible Jewelry Council, and the Responsible Minerals Initiative. And we found that over 90% of the refined gold globally are now covered by these audit schemes. Most of the major gold exchanges and markets worldwide, from Singapore to Chicago to London, have adopted now requirements for refiners delivering gold to go through an audit aligned with the OECD guidance. Again, because of the protection against the various legal market risks, but also the reputational issue. And in 2020 of this year, we are very happy, like I said a few times, with the leadership of the National Stock Exchange. Some of you around the table might recall in 2019, we convened a meeting together with IGPC trying to take stock of progress in India, which was admittedly running very slowly on this, and trying to adopt a sort of a way forward and commitments. And one of the commitments made by the exchanges was that they would adopt these audit requirements for refiners to deliver into their exchanges. And we're very pleased that NNC and MCX have followed through with those commitments. If you look at the world now, you see that more and more of the world map is now covered by these requirements on responsible sourcing of gold. In the green, you have various sort of what we call soft law or international legal commitments and endorsement by those governments to implement this standard. In blue, you have the countries that have adopted this as a legal requirement at the national level. And you'll see India, we have put in yellow there, and that's the signal that national industry bodies have now adopted this as a requirement. Among the industry requirements, as we said, there's, of course, aside also from the big guys like the LBMA and the DMCC, increasingly we also see other smaller actors and traders adopting the OECD guidance, and as well as for base metals, the London Metal Exchange last year adopting this as a requirement. Now, all of this is happening against a larger backdrop that I think you should be aware of, which is increasing legislation in many of the kind of consuming markets for human rights and supply chain requirements, not necessarily focus on gold, but focus across market segments. And so here on this slide, you see the various legislations that have been adopted related to this since 2010. And I think, you know, the most important thing for you to see here is just every year there is just increased scrutiny. And countries are expecting more and more that their companies or anyone delivering products onto their market check that the sourcing of the raw materials and in the production of that materials are done responsibly in meeting human rights and environmental standards. In that process, companies need to prioritize their most severe risks, and that's what our standard helps them do. So now if you look now, what is our main achievements looking back at these last 10 years? I think what we can say and safely say is that, you know, responsible sourcing has become more and more a real market requirement. The market has seen the value of this, not only from an ethical standpoint, but also from a purely business standpoint. Yes, there are some short-term costs. I prefer to refer to those as investments, because these are investments in the business, the future of the business and the long-term resilience, but there are some short-term costs, but we believe that this pays off in the long term. We've seen the private sector buying into these standards and the expansion across metals. We've seen increased understanding and sophistication in the levels of understanding and capacity on due diligence. We've also seen increased awareness of the importance of engaging artisanal miners in a responsible way. And I think what we've saved, you know, some of our achievements is that we've helped create some more market stability in gold, helped to protect against some price volatility and market access issues. So that's the good side of the equation. And in some small pilots, we're actually seeing improvement on the ground. We are seeing less financing to conflict in some metals for sure. We also are seeing more formalization, more money being dumped into the formalization of miners. But there's a lot of challenges still to remain ahead of us. We still think that there are major gaps in implementation of due diligence, that some markets are doing a lot and some markets are not doing enough at all. India used to be in that side of not doing enough at all. I think we're starting to see a change, and there are some leaders in India. There are refiners that have taken the plunge and going through the audits and doing due diligence. And I know at Bangalore Refinery being the first to do that in India, and really congratulate them despite the challenges. And I know that they were very vocal in saying, you know, this is difficult, but it is doable. But there's still a lot of gaps, and particularly in India, I would say. And I would ask, you know, I would still, despite the progress in India, we still note and we hear quite a lot of actors still trying to sort of delay implementation or to sort of distract the conversation from meeting the commitments that they've sort of made. And we would sort of suggest, why are these delays being put forward? What's driving that? And I would suggest that, cleaning up the market is going to create a little disruption. So, we need, though, to keep our eye on the prize and ensure that the Indian gold market is protected and grows, attracts more investment, attracts more financing, so that it can grow and formalize. We think that there needs to be more financial support and financial incentives as well for companies to take this on. Right now, due diligence is more of a stabilizing factor that enables you market access. But we're not yet seeing a sort of premium, a price premium for responsible source, only in maybe some limited circumstances. And finally, I think it's really critical to note that criminal exploitation of gold is still rife. And that's related to responsible sourcing at the mine, but it's also related to criminal activity and the use, and I would say it's probably the misuse of gold as a vehicle for money laundering and for smuggling. And I think we've seen a lot of reports of that in India. So I think I'll end there. I'm happy to share this presentation. At the end, there's also some other slides of more work we are doing and other data, but I want to leave time for conversation. Thank you, Professor Sahay.
Thank you, Tyler. I owe an apology to Nagendra. As soon as I saw your slide with NSC sponsored standards, I realized that I had missed out his name. He's also one of the speakers over here. So let me move to the next speaker, Mr. Ankur Goyal, Vice President representing today the Association of Gold Refineries and Mints, though he's also associated with MMTC PAMP. Over to you, sir.
Yeah, thank you, Professor Sai, and sorry for that unmute thing which happened in between. I would like to take the cue from what Tyler said about Bangalore refineries venturing into RMI accreditation. So what we see is in India, past few years, there has been a lot of development in this field on the responsible sourcing side. Though MMTC PAMP took it up a long time back, as we see OECD started in 2011, and with LBMA coming into force, followed by DMCC, and we had two other accreditations, international accreditations, which were Responsible Minerals Initiative and Responsible Jewelry Council. The difference, what perturbed the Indian refiners as to, is it too difficult or is it too easy to get it? What they realized was, no, this is too difficult. But what I think in the past few years, what initiative taken by all these agencies, I would say LBMA, RMI, and RJC, I think Kinjal is there in the conference, have taken that it is not that difficult. People, whoever can do it. Now, if I see what's the difference between all three, some do have certain stringent measures, stringent requirements. LBMA is one, or DMCC is one, which deals with financials as well as some technical aspect, while the RMI and RJC are more on the practices which is followed and the due diligence, which is, or the responsible sourcing, which is being followed. So if we go to LBMA as such, I would say LBMA has two criteria. One is definitely the accreditation, which is the technical aspect where you need the lab to be accredited, followed by your good delivery bars, which is the large bars of 400 ounces and the silver large bars of 30 kgs. But I would say we do have in India, MMTC PAMP took up this and they are both gold and silver accredited, but we are not the only one. We do have Hindustan Platinum, we do have Hindustan Zinc who are accredited into LBMA Silver good delivery. So what I would say is we should all now understand, and with Bangalore refineries getting the RMI accreditation, it is we need to understand that it is not difficult. It's only a bit of mindset, a bit of hesitation. And once the awareness is created, we all can venture into, and I would say with the other, what you can say, help both from BIS with coming with the good delivery standard, where it has been used by NSC as well as MCX to a certain extent. and the NABL, which has helped a lot of refiners to achieve that technical milestone which is there in LBMA. Quickly, I would just say what does the LBMA does is there is a process where you have a pre-audit, you have testing of the samples, you have technical stage, then you have to send the bars to London to check it up, and then once it is approved, there are referees. Once it is approved, then you are getting the LBMA accreditation, followed by proactive monitoring and retesting of bars, which can give you a continuity in the accreditation. What the RJC does is RJC is more into has two aspects, I would say. One is the chain of practice and chain of custody. So what RJC would help to set the standards for the refiners as well as the jewelers, so that the customers, it will give the customer that satisfaction. So the chain of practice is widely used in India. There is a lot of jewelers and the watch manufacturers which are using it, while the chain of custody is again can give the assurance for the product and material to the customers, and that also can be achieved by following the responsible sourcing or following the OECD guidelines of responsible sourcing. What I can say, I'll just share my screen. 1 second. There might be some issue. So what I would say is for the responsible sourcing, what we can say is there are the 5-point guidance which is given by OECD, which works on the aspect of establishing a strong company management system, identify and assess the risk in the supply chain, design and implement the management system to respond, arrange for an independent third-party audit of supply chain due diligence, report on the supply chain due diligence. Following this, what we can do is we can always do a third-party audit. We can always do a basic KYC for our suppliers, a world check, followed by their financial and license check, the origin of the doré which is coming, and assessment of mining practice, which will include like no human right abuse, including child labor, conflict-free, no money laundering, no corruption, no negative environment impact, and no health and safety issues. This followed by an on-site visit and the KYC for all chains. This can be done both for the mines as well as for the recycled material, which we are currently also getting in India. And India has almost 25,000 tons of gold. And there's a lot of recycling material. So we can accredit ourselves with the chain of custody of RJC through this recycled material also. That will give a lot of confidence to the customers that India is progressing and all our refiners are progressing in these lines. What I could also add is for all this, LBMA follows a very strong proficiency testing system, and of late, even now, Indian government Mint has got accredited for proficiency testing. So that is one body where all the refiners can align themselves, which can help them to achieve the first step of the LBMA also. So the road is not far, where I think in due course of time, all that hesitations or all the inhibitions which our refiners have can be solved. Only thing what we need to do as the policy center is how we can educate all the refiners, how we can make this much more simpler so that they can really think of venturing into this accreditation and having a responsible gold kind. This is what I would like to say. I am open for any questions. Thank you.
Thank you, Ankur, very much. Let us go very quickly to Nagendra and to Harish Acharya, and then we will open it up for a discussion. So Nagendra, if I can invite you, please, Mr. Kumar.
Yeah, Professor, thank you. Good afternoon, Taylor. Good to see you. So, Professor, what we have as an update is that we have empaneled 4 refiners. I mean, we went through a process. Ankur put it very nicely, saying that it's a mindset issue actually. I mean, when we started off, we had a lot of interest, but as part of the funneling process, we were able to shortlist only 4. But having said that, we have issued an empanelment letter to one of the refiners, and we are waiting for some deposits to be placed before they come on board. And as part of the process, what we also do is that we do an evaluation of the refiners. We do an on-site technical evaluation, process evaluation, and based on the score assigned by the inspector, I mean, we have appointed Alex Stewart, then we take it to the committee. I mean, it is only based on the committee's recommendation. I mean, the committee is not given the name of the refiner. We just present the findings of the assayer, the inspector, and the committee takes a call. I mean, the chairman of the committee is from Mint. I mean, the India Mint, and you have all the associations heads as part of the committee. So now what we have done as part of our standards is that, the Ankur was trying to say what LBMA does vis-a-vis RJC and RMI. So LBMA not only has a very well-defined, structured, time-tested, responsible sourcing guideline, I mean, the 5-point principle. They have also laid out criteria in terms of what the financial requirements should be, the production capabilities, and a lot of testing requirements. So without overcomplicating, what we have done is obviously, I mean, you have to look at the global benchmark standards. And when we came up with our standards, till such time that the refiners get audited by any one of the OECD compliant programs, like, I mean, we are working with RMI closely on that. So we said, based on this 5-point principle, we had appointed an internal auditor where, we are going to start the process audits. This is for the refiners who are empaneled. I mean, the best part is, we have not seen any traction, but still I am going ahead to do the process audit. At least from a process perspective, we are complete, right? So whatever we have defined in the standards. So we are again looking at OECD principles as the base, BIS standards as the base. And I mean, Ankur also mentioned about world checks. I mean, everything is being done. So whatever are the findings, again, we will present to the committee. I mean, the refiner can say, I have not delivered anything on your exchange, but even if, in spite of that, if we find some loopholes, I mean, we're going to come up with necessary alerts to the committee, and we want the committee to, advise us on the next steps. So in terms of the 4 refiners, I think, we had multiple workshops. I mean, Tyler's team, Mariana, and the local team here have been very supportive. We had multiple workshops and one-on-one sessions for the refiners. And it's because it's a mindset issue. I mean, there are 16 set of documents, Professor. I mean, which they have to be complied with or, made ready before they agree for an audit date. So that mindset issue was, I mean, a big stumbling block. I mean, it is all there in the mind. I mean, like, see, making a huge set of document, and RMA was willing to give all the assistance, but there was a resistance. So one refiner, I mean, Bangalore refinery is on the conformant list. And you have on our empaneled refiners, Augment, who's on the active list. If you go to RMI website, we will see Augment, they have agreed for an audit. And it's once you submit the bare minimum documents and agree for an audit date, your name appears on that list. So Augment is one, and the other 3 refiners, I think, RMI's team is handholding them, and shortly we should see those 3 refiners' name also appearing. And for the other refiners, I mean, NSE, I don't know whether we have created this as a problem, because until unless there is a minimum score and the assayer being happy on his technical visits and process, we will not empanel them. So for some of the refiners whom we are inspecting, there are multiple rounds of inspection. And for every round, I think, we are burning money. I mean, it's a cost to the exchange. But having said that, again, somewhere we want to create a difference to the society and in the industry. So that is one. And finally, before I end, the professor and to all the other panelists, see one fundamental problem what we have is it is not just onboarding refiners and trying to generate business on the exchange platform. What we also have noticed is that the availability of doré, right? So some of these refiners, I mean, who work with small scale artisan miners, I mean, OECD guidelines doesn't prevent them from sourcing from them. But the problem is with our customs. I mean, the customs clearly says that, the bar should be of minimum 5 kilos, right? But when you're sourcing from small artisanal miners, as per OECD guidelines, I mean, some of them are giving it at 2 kilos, 3 kilos. And obviously you're forced to go to an aggregator, right? When the aggregator mixes all these things, you will not have a single miner certificate. So there are some structural problems. And if they go to a large scale miner, right? He says, boss, do you wear a LBMA hat, right? For me to wear a LBMA hat, again, I need to do 10 tons in a year. I need to have so much net worth. Again, you get into a Abhimanyu sort of a circle. So that's a challenge where I think, if the policy center can help us out, not help us out, help the industry out in terms of, how, because we don't know when these guidelines were written. Right. So as things evolve, when, now we have these standards in place, if the center can, work with the industry and work with the customs to bring about some changes for the betterment of the industry, I think, it'll be a fantastic move, Professor. I mean, that's it from my side. If there are any questions, I'll be happy to take it. Thank you, sir.
Thank you, Nagendra, very much for that very interesting update. We'll very quickly go to Vasubhai, Mr. Harish Acharya. If you can take a few minutes to share your thoughts, and then we'll open it up for discussion.
Good evening, all of you. And thank you, Taylor. I will show you for such a long time. And I will speak in Hindi, but I know you are knowing the Hindi very well. So that's why, little bit I know. So please bear with me. और सबसे अंकुर जी को भी मैं congratulate करता हूँ क्योंकि he is the vice president of our association, refinery association now. And हम लोग जैसे refiners को सबसे ज़्यादा fear किससे है वो हम आपको जस्ट मैं अपने एक अंदाज से बताता हूँ कि मैं 2008 में एक छोटा सा रिफाइनरी ओपन किया था मैंने 2008 से लेके 2016 तक एक स्मॉल स्केल यूनिट चलाने के लिए हमको बहुत सारे कॉम्प्लायंसेस फॉलो करने पड़ रहे हैं जैसे कि हम BIS का करवाते हैं NABL करवाते हैं पॉल्यूशन सर्टिफिकेट लेते हैं RMI ऑडिट अभी हमारा चल रहा है मगर वो इसी एलेक्स स्टुअर्ट का ऑडिट हो चुका है तो हर महीने कुछ ना कुछ ऑडिट्स चलते रहते हैं तो जैसे ही RMI का ऑडिट का नाम सुनते हैं लोग कि RMI ऑडिट है कुछ हमारा गलती निकालेंगे हमारा इंपोर्ट बंद हो जाएगा DGFT हमारा लाइसेंस कैंसिल कर देगी ऐसे फियर्स में लोग रिफाइनर्स रह रहे हैं ज्यादातर पर ऐसा कुछ नहीं है मैं जैसे 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 उसको जानने लगा जैसे NSE ने उसको प्रोसेस में लिया और RMI से हमारा 1-to-1 इंटरेक्शन हुआ कि जो पेपर वर्क हम लोग कर रहे हैं वो पहले से ही प्रॉपर है और बहुत ज्यादा हम उसको कॉम्प्लिकेटेड हम खुद बना रहे हैं क्योंकि जो हम ऑलरेडी कर रहे हैं वो एकदम जो इंडियन गवर्नमेंट और इंडियन कस्टम्स ने क्लियरेंस के लिए जो गाइडलाइंस दिए हुए हैं ये गाइडलाइंस हम फॉलो कर रहे हैं जो सर्टिफिकेट ऑफ ओरिजिन आते हैं माइनिंग कंट्री से ही फ्लाई हो रहा है मटेरियल इंडियन कस्टम्स में एडवांस रेमिटेंस नहीं जा रहा है तो जो भी प्रॉपरली गाइडलाइंस है हम ऑलरेडी फॉलो कर रहे हैं बट हम लोग डर रहे हैं बिकॉज ऑफ फियर कि हम ये कैसे प्रोसेस कर पाएंगे और हमको इसके कारण हमको कोई ब्लैक लिस्ट न कर दे क्योंकि जो हमारा इन्वेस्टमेंट है और ज्यादातर जो माइनर्स हैं वो जैसे रिफाइनर्स हैं वो बुलियन डीलर से कन्वर्ट होकर रिफाइनिंग इंडस्ट्रीज में आए हुए हैं तो वो डरते हैं कि ये प्रोसेस में हम लोग जस्ट हमने इतना बड़ा इन्वेस्टमेंट किया है और हम लोग को कोई उसमें कॉम्प्लिकेशंस में डाल के क्योंकि इंडिया का लॉ जो कॉम्प्लायंसेस इफेक्टिव है जिसमें बहुत सारे डिपार्टमेंट आते हैं, कस्टम आता है, DRI आता है, ED आता है, इनकम टैक्स आता है, तो हम लोग डरते हैं कि ये कहीं हम लोग इसमें कहीं कोई चीज हमारे से चूक ना हो जाए और इससे हमको कोई ब्लैक लिस्ट ना कर दे। यही रीजन से कारण बहुत सारे लोग इसमें एंटर नहीं कर पा रहे हैं। तो मेरा मानना ये है कि हम लोग इसको एक नॉलेज सेमिनार के तौर पे ले रहे हैं। अभी जस्ट आप IGPC ने एक अपना आर्टिकल दिया था, आपका इकोनॉमिक्स टाइम में एक आर्टिकल आया हुआ था, इंग्लिश में शायद साय साहब ने लिखा था, तो उसमें लोग पढ़ के उसको डर रहे थे, मगर बेसिकली वो एकदम क्लियर था कि इसमें डाउट है कि आप उसको डाउट को क्लियर कीजिए, आप ऑर्गेनाइज होइए। तो पर्पस था IGPC का सबको ऑर्गेनाइज करने के लिए, मगर लोगों का पॉइंट ऑफ व्यू सेकंड वे से ले रहे हैं, यानी वो पॉजिटिव नहीं देख रहे हैं, वो सिर्फ नेगेटिव पार्ट देख रहे हैं। तो मेरा मानना ये है कि हम लोग अभी जो इंडस्ट्रीज में हैं उसमें फियर पार्ट्स हमको थोड़ा साइड में रख के उसको नॉलेज पार्ट को ऐड करके हम इसमें आगे काम कर सकते हैं। IGPC और OECD वी ऑलवेज हेल्पफुल हैं, and IGPC और OECD मिलके we are doing some seminars for that, our next IBJ conference, or we will do something for refiners who this year or go out. I think Ankur will be help us for this because he is already process on that. He is going through one process on that. So Ankur is a very knowledgeable guy, and I always hear about him. He is a very after Khosla sir, he is very helpful for other. And I will finish my speech over here because very few time is there, and that's why I will tell you my fear and my truth for my industries. Thank you, sir.
Professor, if you could comprehend in English, it will be good for Tiger.
The essence of what Harish Acharya kind of shared with us was that there is some element of apprehension and fear as well in many refiners, even though they may have been doing everything which is quite kosher. But the drive to follow the OECD guidelines and to make it into a much more formalized way of doing things and audit and so on. So some level of apprehension has kind of crept into the minds of many of the refiners. You know, are we going to get caught up in some legal hassles because of this from the many different agencies of the government or regulators? And that may also actually militate perhaps against the cause of the movement in the direction that all of us here are actually interested in moving towards. So I think that to me that was the gist of what was being said, and I think it's probably a genuine apprehension because if you've been operating in a certain way, however kosher it is, when you try to formalize and there are all these processes and so on, which one is not familiar with. So some of the work that I do in behavioral science basically essentially says any change is always difficult. And so when that change is happening rather rapidly, it becomes even more difficult. But I'm sure that the industry is very much cognizant of what it needs to be doing. And as Nagendra has shared with us, there are process issues and mindset issues, and as Ankur also shared with us, that there are process and mindset issues. But it's a matter of taking the first steps and moving forward. And I think NSE in particular, but everyone here needs to be complimented for having taken that first step, because the first step is always probably the hardest step in this direction. And now that there is one refinery which is almost there, there are another one that's agreed to the thing, and there are 3 more in process. I'm sure that will lead to a very large level of movement for the industry as a whole, and with standards also becoming more required. Hallmarking is becoming mandatory, and all of those things. All of those taken together should help us to move in that direction. We must thank OECD for having started the whole process almost a decade ago, and over a period of time. Dodd-Frank and EC regulations of 2017. I was quite amazed to see that DRC is also there on your list of hard laws. I'm a little less inclined to believe that completely, knowing what little I do of DRC. But for the moment, I'll take your word for it, Tyler.
Well, I should just note that there's a difference between laws on the books and laws that are enforced. And I think
so I'm happy.
in India, you might suffer also from some of the same problem of what's on the books versus enforcement. And I think that is an issue there in that context as well.
That makes things a lot clearer. So hopefully in India we will move more cogently, quickly in the right direction, and with leadership being displayed by organizations like NSE, I'm sure we will make a good solid movement. And I think we must all give a huge round of appreciation to the organizations which are investing money or burning money right now, in a sense, to set up the market. And I would like to hope that these organizations at some point in the future are able to enjoy some of the fruits of this effort going forward. So open to questions. Anybody has questions, observations, or any of the panelists would like to add, please feel free. We can possibly go for another 10 minutes before we wind up for the day. I know I'm very conscious that we are almost an hour behind time, but feel free. So we'll go with Ankur and then Tyler, please.
I just want to add, thank you, Asu bhai. We are always there. हम लोग हैं, and जो आप कह रहे हो, जो फियर की बात है, मैं ये बोलता हूँ वो है, और ऐसा नहीं है कि हमने इसको बहुत साल पहले किया, हमें नहीं है, हमें भी वही चीज है और वो सारी चीजें, बट जैसे जैसे हम ये करते आ रहे हैं हमें पता चल रहा है कि we are able to do it and it is not that difficult. Right now we are going for RJC, COC, we have got COP, but we are going for chain of custody. We should get it within a week's time. But there are issues which we try to solve it, and it's not that difficult. And I would say simultaneously, one for OECD has started a decade ago, but simultaneously, I would say for our refiners, the kind of positivity which is being seen in the last few years with the last OECD conference, which I attended, where there was so much negative, we can't do it. What I see today is even NSE is getting the refiners empaneled, and all the MCX has got them paneled with various compliances which they are trying to follow. I think hats off to the refiners also, which they are taking the next step.
Tyler, please.
Yes, thank you. धन्यवाद. मेरा थोड़ा तरह समझता हूँ, लेकिन मेरी कोशिश करता हूँ मैं.
काफी समझ लिए. I think I'm very, very impressed.
नहीं. Lekin I'll switch to English, though. I'll also make a fool of myself. No, I think the trajectory is very positive in the last year. I think it is a mindset issue. Change management, as you said, Professor Sahe, is never difficult. One of the things, looking back, is I do think there's a lot of energy also that was focused on, questioning, stopping, the process. And I, just really would encourage those that are still skeptical to try to channel that energy to actually understanding what needs to be done rather than putting more barriers in the way. It's great that we're positive here. The tone has changed, but there is still a market segment that is saying one thing and doing another. And I think we have to recognize it because it's a bit of the elephant in the room here, right? We have refineries that are changing names, and one refinery might be good and others maybe not participating. And we have to recognize there are still problems. And when you address and try to fix problems, it's going to piss people off that are engaged in the misconduct. So I think that it seems complicated, but actually it's not. About asking questions and thinking, the gold industry is phenomenally intelligent about hedging risk and thinking about futures. And, I can't figure that out, So if you can figure that out, you can figure this out, which is just about, does this smell right? That's it. That's really it. Check world check my tier one supplier. The point about the aggregators, I think is a really good point. And if, there's a policy barrier on customs to importing less than 5 kilo, maybe that's something that needs to be addressed. Another way to do it is to try to cascade some of that responsibility onto aggregators. So if I have a business relationship with an aggregator in Ghana, I really focus on taking that aggregator and making sure they can do the sourcing correctly, so that when they offer me 5 kilos a month, aggregated artisanal, I have some confidence that that stuff is sourced responsibly. And I think there needs to be more work to be done to look at the aggregators and how we could build their capacity, because without them, it's going to cascade onto the small refiners here. So I think we're very, very positive. We are positive, and I just think that the work of the NSE, I hope it's not burning money. I think it's really an investment in the NSE's growth and future. And just again, want to congratulate Nagendra for the work that you've done. Thank you.
Thanks, Taylor. Thank you.
Any questions from the people in the audience, please?
Well, I think it's.
Som, you are not audience, sir.
No, I just.
Feel free.
No, I think this is also has become a little emotive issue in terms of as Vasubai rightly said, yes, there is investment, but it is important also to collectively pull the things together. Otherwise, 5 years from now, things are going to get a lot more difficult. We just saw Terry's presentation on ESG. We haven't even started talking, whereas the big companies in India, look at Infosys, they are already saying they are going to be carbon neutral 2030. Hindustan Lever has said something. Big companies are just moving to a different, level, and we can't be at this level and always expect the Indian government to, have the lowest common denominator for the basis of legislation and enforcement. We just have to live up to the global standards. And particularly, I can understand a couple of years ago, the government was not opening up the market. I mean, when I say as far as gold is concerned, now we are going to have the bullion exchanges. Now it's important for us to crack our heads to see how these exchanges and improved trading can give us more money. There's no point. The refiner had to do an OTC trade. Now he's having the entire gift city, Yeah, there is a regulatory thing about exports of bars, but now he's having opportunities are going to increase. For those who don't, some of us have read, they're also saying they're doing something about mining. And gold monetization will certainly, and Arvind, that next 5 years, if you look back, it is going to make some dent, some change, definitely. So you got to be a little more prepared for what's coming rather than saying, let everything happen. Then if it is good for me, I'll change. So, but it's important that some of us, particularly the influencers and the associations in, exchanges, we just put our heads together and make sure that everybody in the industry either meets the standard or they just understand that they are on their own, So it is important, but there is definitely a lot better scenario today. So we should be thankful for that. That's all. It's just a comment.
I have a question to the panel members. So we had this discussion is also to take up some of the recommendations that are put forward in the report. So to Ankurji and Harish Bhai, Vasbhai, the question is, we had a recommendation that link the imports, link the incentive for importing dore to responsible sourcing. In the sense, you get third-party audited. So, is there something would you recommend? Ankur as a representative of AGRM, not and Vasubhai as IDJ, is there something would you recommend, or you think the market should be kept open and there be more volunteer?
So what I can add to it, I think whatever is the gold policy center position paper says, definitely, and what we have talked out and what Mr. Nagendra also has said, first, the most important thing is which can help the small refiners and to look to source it is one thing, to have it from conversion from 5 kgs to 2 kgs of import. That can be the first thing, followed by even the aggregator approach is still not there. And I think the position paper has really outlined, though they have taken aggregator as the thing which has already been approved, but that is one stand which we need to take it, whether how we can have a due diligence properly done, because still the customs is are asking for a mine, and then as the paper says, the mine goes into a very different angle altogether, followed by how we can also help the refiners grow, which is like the gift exchange, like hedging internationally. And definitely for the refiners, it's always the duty difference. And with that, and with this inhibition going away, I think getting a third party audit is not very difficult. So we can propose it, though it's still that initial hitch is there, ki a third party audit, what Vasubhai was also saying, pata nahi kya hoga, what will happen, we don't know about it. But definitely we can make it more easier. We can convince, or we can make it more easier for the refiners to start adhering it. Initially, we can have it voluntary, or later on, we can really go how we can work out with the refiners so that they are agreeable to going for a third party audit.
I just want to add our OECD support behind that proposal in that policy note. We think it's very wise to create a financial incentive also to offset some of those costs. And as I said, these are investments. The due diligence is an investment. But if at first you can find some liquidity, that's whether it's through a customs or sort of import duty incentive, that will create more and more from a behavioral side desire to clean up. So we definitely would support that. I would also say that I think in our view, eventually this should become a legal requirement in India as well, potentially for licensing good delivery or India good delivery, because I think if it's as it is now, I mean, I do think NSE will have a competitive edge over other exchanges in the future, but we need a level playing field in India too, I think. So I think a legal requirement is also necessary. Thank you.
Okay, so on that note, I think I'm going to officially call timeout. We are almost past 7:30, half an hour over time, which is actually not bad by the traditional Indian standards. And I can see Tyler smiling away with his long experience of India. So thank you very much, everyone, for very patient participation in a day which actually has been quite illuminating in many different ways. And I look forward to starting again tomorrow morning at 10 o'clock. So look forward to seeing many of you here tomorrow at 10.
Thank you.